Good afternoon to you. So,
Good
I'm
afternoon.
sure I have sent an email to you with the group allocation, and the allocated topic also mentioned in that particular list. Okay, actually, Kasun helped me in preparing that list. So I sent an email to you yesterday. Hope you received it, but I just want to explain it. So you have to start downloading articles. I mean, that process you must finish within a week, during next week. So all the group members should send, the leader can send the downloaded article with the rating. I mean, the email you have to mention whether it is A or A star or A rated article, or article downloaded from A star or A rated journal. So that is also you have to mention, and when you are sending email, so please mention either your group number or the allocated topics. Then I will quickly go through whether it is relevant to the allocated topics and whether that article is suitable for evaluation. Because in that particular email, I specifically mentioned that if you can avoid literature review article, conceptual or theory building article, or meta-analysis article, that would be better, because those articles are already sometime a review article. For example, journal literature review article, already a review article, it's very difficult to carry out further review. The theory also, this is not high time you to analyze the theory building article, because you have to have a solid understanding about theories if you are going to analyze the theory building articles. So try to avoid those articles. Meta-analysis article means it's again the review kind of article where the researchers try to do. I mean, they normally summarize previous article finding on the same topic, and they try to analyze using the specific statistical method. Those kind of article actually we call as meta-analysis. So that particular article also already a review article. So because of that, it's little difficult to carry it out further review. So that's why I ask you to find out the empirical research. Okay. Roshan sir, is it possible me to just share the screen?
Yes, sir, sure. Yeah.
Okay. Yeah. You simply, I'm sure you can see my screen right now. So very first instance, what you have to do, find out whether it is a empirical study. Very first instance, you have to find out the journal from which you have downloaded it. Okay, so as you know, the British Accounting Review is a journal, so then it is okay. Then you can find out and go through the abstract or within the segment. If you have hypothesis, data, sample selection, data collection, those kind of segments are there, then you can decide that's a empirical study. Okay. Likewise, and some article actually, not such way, but some analysis you can find out within the article. Okay. So those kind of article you can decide that's a empirical kind of studies. So this is another kind of thing. Say there's some statistical analysis you can find out within the article. So then you can decide that's a empirical study. The most that's the easiest way to find out it. Just go through the abstract and read through the design and methodology segment. Because some abstract you can find out this approach in writing abstract, where you can find out what the method they have adapted, how they have collected the data. Sometimes it may be a the questionnaire survey or secondary data, or it may be interview. So that doesn't matter. Okay, all qualitative, quantitative is not a matter, but I need you to find out an article where some empirical issues are analyzed. Okay, so that is easy for you to analyze those kind of articles. So I'm getting some chat also. Yes, okay, right. So I'm sure. I mean, some article like this, you can't find out the journal name on the top of the article, and here sometime you can find out the journal name. This is accounting, auditing, and accountability. Normally AAAJ, that's a A-rated journal. So that is good. I mean, sometime at the top of the article or likewise, you should be able to find out the journal name. And once you find out the journal name or journal title, please check that title with the ABDC rating list that I have sent to you. Okay, that is Excel file. Under that, you should be able to find whether that particular journal is a star or A-rated journal. Okay, so that's the first criteria. Then second one is whether it is empirical, the test, that is second one. And if you are happy, that the other thing is that the title of the article should be matched with the allocated topics. So if those criteria are satisfied, then it is good for review. Okay. So within a week, please download and send it to me. Then I will quickly okay it. So afterward, as a group, you can start your analysis based on the given guideline. And in the first lecture, actually, I gave you some guideline. Based on the given guideline, you can prepare your presentation. And I will send you soon the presentation schedule. Okay, sometime within 2 weeks' time, we might be able to prepare. Okay, so because of that, as quickly as possible, download a good article and send it to me and get the approval. And afterward, you can start reviewing it. So that's all. Actually, I just want to highlight. Now, if you have further issues to clarify, please let me know. Okay. Some article, actually, at the top of the article, you can find out the journal name. European Accounting Review, also a very good journal. British Accounting Review, Accounting Organization and Society, normally we call it as AOS. Okay, Accounting, Auditing and Accountability, normally we call it as AAAJ. Okay, those kind of, I mean, I'm sure now you are familiar with journals, good journals. Accounting Review, that is an A-star journal. And the management also, management accounting also, the very good journals are there. Management accounting, management accounting review, those kind of very good journals are there. You can go through the list and find out and check whether your article is published in a very good journal. Okay, that's all what I'm going to explain.
So there's a question that they asked that only we need to do a presentation based on that. So
yes, actually, yeah. Actually, what you have to do, you have to prepare a PowerPoint presentation. That's all actually you are supposed to do. And normally 12 to 15 slides. So and that particular slide should include, overall aspects according to my guideline, or overall aspects of the article. So the main thing when you are presenting, the audience should be able to get the concrete idea about the article. So you should be able to review all the important aspect of that article. So I can't exactly say what area should be covered, but important area, all the important area should be covered in your presentation. Okay. So then once you prepare that presentation and in the given time, so I will announce it. Then as a group, you have to come and make your presentation. So at that point, you have to decide how do you going to make a presentation. All the members, that is very important, all the members in the group should make a presentation. They should participate in the presentation, sometime 2 to 3 minutes. Okay, maximum 2 minutes for one presenter, because now already we have 6 members per group, so about 2 minutes presentation. So you have to segment out the presentation among 6 members, and all members should participate. What else?
Sir, excuse me, sir.
Yes.
The presentation may be similar to the research critics method also.
It means?
The research critics method, similarly to the research critics method of the presentation.
Yes, yes. Actually, in that review, you have to identify the gaps also in the research. In a critiques, you are going to identify the gaps also.
No, sir now told that no, everything, each and every aspects to be covered in our presentation of article, no, sir. So
yes.
it may be similar to the research critics method, if it is okay, sir.
No, still I didn't get your point correctly. Again, can you ask?
Yes, sir. Now, sir told that no, each and every aspects of the research article should be covered in our presentation. So
Yes.
based on that, I hope that our presentation will be based on similar to the research critics type. I think that one covered all the aspects.
Yeah. It's like the critic kind of job you have to do. Actually, in the very first lecture, I have explained to you how to carry out the review. Journal article review. Did you go through that particular slideshow afterward?
Yes, sir.
Okay, so you better go through that guideline again. I'm sure then you will get an idea. And the main thing, and finally, you should be able to identify the gaps also. Any research, there might be so many limitations. Some of those limitations actually authors themselves identify within the article at the latter part of the conclusion segment. So in addition to that, you also should be able to identify some gaps of the articles. So those kind of aspects also you have to find out. So remember, even though you are analyzing one article, sometimes you have to do a lot of background reading to analyze that selected article. Okay, sometimes some related article also you have to study to prepare good review of an article that you have selected.
Yes, thank you, sir. Thank you.
That's background reading is very important. Okay, you are asking the presentation online, should we come to the university? Most probably, and due to the prevailing situation, we have to take the presentation online. Last time also we took online.
And so when come to this accessing the materials, I think they can access that to the library from the online So whether they have that chance that really need to.
Yeah, I mean, yes, Roshan sir, I'm sure now they are registered and they are given the LMS access also. Then they can I'm sure they can access to our online library. I mean the university online library.
Yeah.
So if you go to the online library, where you can find out some article database sites within the online library.
So it says that they have not given the library access yet.
That I don't know exactly. That may be a problem then.
So this need to be checked with the coordinator, I think. No, sir?
Yeah, that actually you have to discuss with the Professor Ajwal. So actually I show this one also, that university library. So if you go to the university website, and where you can find out library site over here. So click it, and within the library site, you can find out e-resources. Okay. So if you go to the e-resources, okay, here you can find out e-resources. Okay. So if you go to the e-resources, you can find out journal article database. Those are online database. JSTOR, that is one thing. The other one is online journal. The other one is Elsevier. The other one is Emerald. Okay. Oxford one actually it's a little difficult to find out the article relating to the broader discipline of management, but using these, and if you find out the some title, you can type over here and check whether some good article. For example, if you put corporate governance over here, you can find out large number of articles that is there in this particular database. Okay. So you have 712,186 results. Okay, large number of journal articles. So out of which, I mean, you can fine tune a little bit. Okay, likewise, large number of articles, it's there, because this is you see from page 1 to page 28,488. How many pages? Okay, so you can find out. I mean, it's a huge database, journal article database. So where you can find out good journal article. So ad hoc basis, you can download and check with that particular criteria. I mean, even JSTOR you can go, or otherwise you can go with Scopus, or otherwise you can go with Emerald. Okay, that way you can download, but I don't know whether you are allowed to go. I mean, I'm sure you are allowed to go, but if you have any issue, please check with Professor Ajat. Emerald also, here you can type, okay, simply. Okay, actually I got one chat. We have not given the library access. That is beyond my control, but you have to that aspect actually you have to discuss with Professor Ajat. Okay, I think all the chat I answered, and in addition to that, if you have any other issue, either you can put those issues into chat. Yeah, I got another two chat. when presenting, unmuting mic is enough, or camera need to be switched on. Actually, you have to switch on the camera also when you are presenting. Okay, so you have to use the mic, as well as you have to open the mic, open the camera also when you are making your presentation. And actually, you have to show your ID to the camera first, and afterward you can start your presentation. That's a normal practice. Normally we are having in online presentation. Okay. Still we did not receive the ID, then you have to show your national ID, because we are going to verify your name. That's all. Right. Any other issues? Okay, Roshan sir, I think that's it. I'm sure they are now they are comfortable, but if you have any issue, you can get that get it clarified from Roshan sir also.
Sure, sir. I'll attend them. Yeah.
Yeah.
Thank you very much, sir,
So,
for your time.
okay. Okay. Thanks, Roshan. Thank you very much for letting me to have a session. Okay. Right. Now you can start your the lecture. Thank you very much.
Right. Thank you, sir.
Yeah. Let me stop sharing my. Yes. Stop. Yes. Now you can.
Right. Okay. Thank you, sir. Okay. So with that briefing on the group presentation, so now we are about to start today's discussion. So the materials being shared. Hopefully you all got the materials with you. So today we are going to discuss another important aspect when it comes to the contemporary issues, and that is going to be the disclosures and regulation. So here we'll be discussing some of the contemporary issues relating to the disclosures and regulation. So starting from the learning outcomes. So as usual, at the end of the discussion, you must be able to demonstrate that you have achieved these learning outcomes. So once a particular chapter is over, so you need to question from yourself whether you can demonstrate you are got the required learning. So therefore, once we're done with the chapter, come back and see whether you are there. So in this chapter, we basically expect you to identify the importance of the identification of the reporting entity. Right, okay, there's a request that the materials need to be uploaded one day before. Sure, sure. So we'll be uploading that. Sorry for the delay. So when uploading these materials, in fact, it was yesterday night, this has been uploaded, but we'll ensure that. So in the future that we'll be uploading the materials well in advance. So thank you very much for the comment. Right, coming back to the learning outcomes. So at the end of today's discussion, it is expected you to identify the importance of the identification of the reporting entity. So in fact, this particular aspect we discussed when it comes to the conceptual framework. So in the conceptual framework, if you could recall, we have extensively discussed the reporting entity, the concept of reporting entity. So here also we are going to visit that based on the contemporary nature of that topic. And then identify the debate surrounding the length and frequency of reporting period. So there is an ongoing debate. So when it comes to this reporting period, some would prefer to go for the standardization of the reporting period, while the others prefer a flexible approach to reporting period. So there is a debate going on. So you are supposed to be aware of that. Again, it's a contemporary. matter. And then you must be able to discuss the practice of manipulating reported earnings in the production of financial information. So it's about the manipulation, the earnings management, the fraudulent activities. So you are going to be aware of some of the manipulations that is taking place when it comes to the reporting, when it comes to the financial reporting. So we are going to discuss some of the manipulation that is being taking place. And then discuss the debate surrounding the exclusion of intangibles and intellectual capital from the financial reporting process. So you would know that most of the intangibles and intellectual capital we are not recognizing. So when it comes to the financial reporting, so based on the traditional guidelines, especially this recognition and measurement, based on that, we are not going to recognize most of the intangibles and even the intellectual capital. So we are going to have our discussion on that as well. That is also a contemporary issue. And finally, you must be able to assess the motivation for voluntary disclosures in annual reports. So we are discussing about the mandatory disclosures. So that was what we discussed primarily when it comes to the conceptual framework. And today we'll be looking into some of the voluntary disclosures, and we'll be discussing the motivation and also the theories underlying or behind these voluntary disclosures. So that is another aspect what we are going to cover in the today's discussion. So hence, basically, we are going to discuss some of the contemporary issues relating to the disclosures and regulation. So that is the prime objective of the today's discussion. So having said that, let us move on to, yes. So this is about the products of financial reporting process. So as you can remember, even this particular slide I have made use in the discussion of the conceptual framework as well, in order to show the link between the conceptual framework for financial reporting and accounting standards and the general purpose financial statements. So you could see that when it comes to the conceptual framework, as we discussed, it's a coherent system of interrelated objectives and fundamentals. So that was the comprehensive definition what was given on this conceptual framework. And when it comes to the purpose, basically conceptual framework addresses the broader issues in financial reporting, the broader issues in financial reporting. So depending on this conceptual framework, the accounting standards are developed. So, you know, currently we have 40 odd accounting standards, and these accounting standards would govern the accounting practice. So more precisely, I could say that this accounting standard would govern the general purpose financial statements. So even we define what this general purpose financial statement in our last discussion. So if you can recall that, so those are the financial statement that is prepared to meet the needs of users who are not in a position to demand the information that they want from an organization. So hence, these general purpose financial statements are intended towards the mainly the investors and the other capital providers. So basically we can say it is oriented towards the external parties. So it is having a external orientation. And that was about the general purpose financial statements. And we found that it is a kind of a mandatory disclosure. So in the last class, when we met last time, we basically discussed this aspect. So today, we are placing much emphasis on these voluntary disclosures. So broadly speaking, when it comes to these products of financial reporting process, mainly there are two products. So one is the mandatory disclosures. So most of that would comprise the general purpose financial statements. And the other one, it is going to be the voluntary disclosures. Sorry, voluntary disclosures. Then if I ask you, what are the voluntary disclosures that you are familiar so far? So we'll be discussing them in detail, but just imagine an annual report and think of some of the voluntary disclosures that you would find in a given annual report. What those are? You can think of.
CSR activities.
Sorry?
CSR activities.
CSR activities. Yes, very correct. Very correct. Yes, it's a very important voluntary disclosure. So nowadays, even in the past, I would say the organizations, so there's a practice that they are disclosing their CSR activities. Yes, very correct. CSR activities. It's a very, it's a voluntary activity. Yes. Yes, likewise. So one is that, yeah, the CSR activities. Other than that, you would find in a typical annual report. So I'm sure that each and every one of you have gone through that, the annual reports. There can't be anyone who have not. So then if you think of what else that you have seen. Yes, I like this to be interactive. Yes. So in fact, when you come to the teaching and learning in the master's level, so it's not about a kind of a teaching like we do in the undergrad or something, right? It has to be more interactive. So it's about bringing your experience and sharing that. So that is what add color to our discussion. So hence I would like you to contribute more. Yeah, just to add one thing from my side, that how about a kind of management commentary, in the sense that the chairman's report, you would find that in a typical annual report, you would find that the chairman's message and also the CEO's message. So there they talk about the business environment and their uh, future outlook, right? The risk, the opportunities, what they have. So basically the environmental analysis, their business operations, the outlook, those aspects are being discussed. And it's by the chairman as well as the CEO. So that is also a kind of important ingredient. So when you come to the annual report, again, it's a voluntary disclosure. So the management commentary you can take together with the CSR activities. So now we found two. Yeah. What else? The things what build the brand name of the company. Okay, good. So yes. So we can build on that. So you mean that you're trying to tell that it's about the capital reporting. Yes, nowadays, if you take the annual reports, you would find that the business organizations are reporting under 6 capitals. So, you know, we are talking about the 6 capital model under the integrated reporting. So in that, the brand, what you have mentioned, it's one of the main aspects that comes under the intellectual capital. Yes. So therefore, we can, in broad, we can say it's about the capital reporting, right? It's about the performance reported in terms of the effects on the capitals. So there we identify, more traditionally, we have that financial capital and manufactured capital. So apart from that, in this contemporary business environment, we identify 4 other capital, like human capital, the intellectual capital, social and relationship capital, and most importantly, the natural capital. So therefore, it is something again go beyond the traditional set of financial statement. So it is pretty much voluntary. So you can say, yes, it's about a kind of a capital reporting. So you talk about the environment, you talk about your social relationships, right? You talk about your intellectual capital, you talk about your human capital, right? Which is largely ignored. The strategic information such as company characteristic and strategy. Yes, very correct. So that is also another important thing. So they basically talk about their business strategy and their objectives. So the business organization, in a typical annual report, you would find that the strategic information is there, right? So basically relating to their planning, their strategic planning, the objectives, strategies, even the performance measurement, what they would have, and the performance indicators. And even today we talk about the sustainability development goals, right? That is also pretty much voluntary. The latest addition, the organization tend to talk about, yes, talk about the sustainability development goals. So it's a very popular, it's getting very popular nowadays. And as you mentioned, the risk mitigation at mitigation part to some extent. Yes, broadly we can say that it's about the corporate governance. That is another important area when it comes to the voluntary disclosures. For some organization, the sum of the corporate governance related disclosures may be mandatory, especially if you take the bank and finance companies likewise. But for others, it is still a voluntary disclosure, the corporate governance. So therefore, this risk mitigation and the profile of the management committee, the profile of the board of directors, uh, those things. And so whatever the mechanisms that they would have to mitigate the risk, as you have mentioned earlier, those aspects, yes, that is pretty much voluntary. So in broad, we can say it's about the corporate governance. Corporate governance. That is also correct. Vision, mission statement, basically we can capture this under the business organization's strategic information. No? Under the strategic information, you have this vision, mission, objectives, strategy, and the business model, right? Everything comes under that. The environmental analysis, opportunities, the risk, right? So everything comes there. So it is about kind of analysis of the business organization, the strategic aspects. So likewise, yes, it seems that you are pretty much clear with the concept what we are discussing. So when it comes to these voluntary disclosures, yes, there are certain disclosures we would find. So if I'm to summarize some of the things, the information about intangible assets, example, intellectual capital, yes, that's what I discussed earlier even. Yes, you are very correct. It was about the capital reporting. Right. Then thank you very much for your active contribution with this respect. So when it comes to these voluntary disclosures, yes, as we discussed, we can see one of the important things. It was about the chairman's message and the CEO's message. So we can say the management commentary and the corporate governance we have identified. Then the strategic information we have identified, and also the corporate governance. So these are basically the voluntary disclosures together with the CSR activities, as you have mentioned very correctly. So that is about the voluntary disclosures, right? So now you are clear with the mandatory and voluntary disclosures. Okay. So the today's purpose, today's discussion, the main purpose is about identifying some of the contemporary issues that is revolving around these disclosures and regulation. You know, when it comes to this, the 21st century, uh, when it comes to this financial reporting, this is a kind of model that was invented some time back. So the suitability of the traditional financial reporting model is always questions. So there are certain areas where the critics would question the applicability or the suitability of this financial reporting for the 21st century. So there are certain criticisms, as well as when it comes to financial reporting, you know, it evolves, right? It does not, it is not a kind of a static thing. It evolves. So therefore, the most of the criticisms, I would say, most of the criticisms being addressed. So the criticism being raised, and also the financial reporting has been able to address most of these criticisms. So we may have a look at some of the valid concerns that is being raised over the financial reporting and how it has been addressed so far. So that is what we are going to looking at. The financial reporting methods are seen to be out of touch with the needs of 21st century investors. The sum of the issues and criticisms of financial reporting are the identification of the reporting entity. This is one of the main issues that has been there for a considerable period of time. I would say that this was there without being solved till 2018, I would say, right? When it comes to a definition on this reporting entity, the recent conceptual framework have been able to achieve that. But until that, there were kind of debate on that. What is a reporting entity? So there were no a precise kind of definition. There's no kind of a agreed definition on this reporting entity till 2018. But as I said that the financial reporting, it is evolving and it is addressing most of this criticism. So therefore, I can say that when it comes to the today's environment, this particular issue, it is being addressed to a large extent. So especially in 2018 conceptual framework, they have precisely defined what is a reporting entity. What is a reporting entity being precisely defined. So therefore, the identification of the reporting entity issue, it is being addressed to a large extent. And also another criticism, what we would see is that the lack of timeliness in the publication of financial reports. So that is being questioned. So at the time, the financial statement provide the information, the value relevance is less. So I mean that the timeliness of the publication of financial report, again, it is a area where the critics have questioned. So again, to a certain extent, this has also been addressed, especially by way of interim financial reporting, with the introduction of this interim financial reporting, where we may report our quarterly performance, or biannual performance. So by doing so, to a large extent, this issue has also been addressed. But still, the criticisms are going on. And also, there are certain questions over what is included in the financial statements, which raise the issues of the conceptual primacy of assets. So here, especially when it comes to that intangible assets, the conceptual primacy of the assets being questioned. So, when it comes to the definition of this intangible asset, so it's a very kind of rigid kind of definitions are there. So therefore, it sometimes compromise the conceptual primacy of the assets. When it comes to the conceptual framework, this asset is going to be a kind of very dominant concept. It's a very dominant concept, the asset. But when it comes to the regulations, how it defines the certain asset, like intangible assets, so it has to a certain extent, it has compromised this conceptual primacy of assets. So that is another criticism what we have on this financial reporting. And then the manipulation. So this financial reporting, in that environment, still this regulation, even though we have regulations what avoid this manipulation to a large extent, but still the policy choices, the estimates still allow or provide room for the kind of financial reports preparers to manipulate the reported numbers. So that is also a criticism what we have on the financial reporting. And what is omitted from financial statement and how these are reported. So again, this is relating to, when it comes to financial reports, basically we are reporting on the financial performance. So, or the economic performance, I would say. So the social performance and The economic environmental performance, that is largely being ignored. So when you come to the traditional financial reporting, but nowadays we are addressing them to a large extent. So we have this sustainability reporting, and even we have this integrated reporting nowadays. So these new reporting mechanisms, new reporting frameworks have helped us to address these criticism to a large extent. So nowadays, the business organizations are very keen on reporting uh, their implications, their impacts on the society as well as the environment. So that is through the sustainability reporting or even through the integrated reporting. So when it comes to this integrated reporting and sustainability reporting, you have dedicated sessions. So in that, we'll be discussing these aspects in detail. Then finally, how financial statements are reported. So that is the how financial statements are to be distributed. So it is about the electronic reporting, things as such. So these are some of the criticisms what we have on the financial reporting, and we are going to see the current status of these criticisms, how it has been addressed over the years. So from this point onwards, basically what we are going to do, our discussion would revolve around the points what we have made over here, and we'll be taking each and every one of these points, and we'll be discussing what is the present status and how these criticisms have been addressed and what is going to be the future. So that particular kind of discussion is what we expect to engage in, right? Okay. So having said that, let us start with the reporting entity. In fact, this is something what we have discussed, so we need not to take much time on this, but just to take you through. So when it comes to the reporting entity, as I said that it is a question that was there for a long period of time without a precise definition. There was certain effort being made to define this reporting entity, but it was not agreed. It was not agreed totally. But when it comes to this, the most recent conceptual framework, that is 2018 conceptual framework, there they precisely define what is a reporting entity. So as it is said that even as I highlighted, it has two basic aspects. So as you can see, a reporting entity is an entity that chooses or is required to prepare general purpose financial statements, right? So it talks about two things. What is that? So there are certain entities who would require to prepare the general purpose financial statement. So as I discussed, that is specified business entities. So that is identified by the Accounting and Auditing Standard Act number 15 of 1995. So there are certain entities we have identified, they require to prepare the general purpose financial statement. For example, if you take the public listed entities, they are specified business entities. They require to prepare the general purpose financial statement. And at the same time, there may be certain entities who would choose to prepare the general purpose financial statements, right? So if a particular entity wishes, let's say it's a kind of a private limited entity, but if they wishes to prepare a kind of a general purpose financial statement, yes, they have the chance to do so. So hence, this is a very broader definition. So it captures the entities, those who would require to prepare the general purpose financial statement, as well as the entities, those who chooses to prepare the general purpose financial statements. And again, when it comes to the reporting entity, it precisely says that it always need not to be a legal entity. So we discussed this. So even, in accounting, we are looking at the substance over the legal form. So therefore, we prepare the financial statements considering group of entities. But if you look at the legal form, so it is the group of entities, it is not a legal entity, but it's a kind of a reporting entity. It's a reporting entity. So therefore, it is always need not to be a legal entity, but even it can be a kind of a accounting entity or entity that we created for the reporting purpose. That is another aspect what we highlight over there. The financial statement provide information about the asset, liabilities, equity, income, and expenses generated by the set of economic activities that lie within the boundaries of the reporting entity. So once you precisely define the reporting entity, so there you report on the elements of financial statement. So relating to the reporting entity, asset, liability, equity, income, and expenses being discussed. The information relating to these elements of financial statement are being communicated. Yes, you can see that some of the main points highlighted in this definition. Reporting entity need not to be a legal entity. It can be, or even it may not be. It should be an economic entity, or it's a reporting entity, the entity that we created for the reporting purpose, and could even include multiple entities. The classic example, the group of companies. So once you obtain the control over another, you become a group, the parent subsidiary relationship. So that is what we call the group. So it is a multiple entities, right? Okay. So it's about the reporting entity. Yes, would like to ask you, are there anything that you would like to add on this reporting entity, or anything that you would like to clarify further on this reporting entity? I think that you're pretty much convinced with the concept that even in the other day we used to discuss this reporting entity concept. I think it's a very straightforward thing. Yes, any thoughts? Clear with that, or anything to add? Are you all fine with that? Reporting entity concept?
Sir, excuse me, there's a question.
Yeah.
Whether the reporting entity refers to the company also other than the companies also.
Yeah, good. Yeah, when it comes to the reporting entity, yes, it is very clearly mentioned here that reporting entity can be a legal entity. So in the sense, if you take a company, you know, it is a entity that is incorporated under the Companies Act number 7 of 2007. So therefore, it is a legal entity. So if you take a company scenario, it's a legal entity. But if you take a kind of group of entities, in that particular case, you know, if you take the individual entities involved, they are legal entities. Let's say that you are a PLC and you obtain the control over BPLC. That means the two entities are individual entities. The individual entities involved, they are legal entities because
Yes,
each company is incorporated.
Yeah, here the not necessarily a legal entity like that. There is one point.
Yes. Yes.
Not necessarily
that
a
is what
legal
I'm
entity.
trying to explain. So when it comes
all
to
the
that,
companies are the legal.
sorry.
If
Sorry?
all the companies are normally under
Legal
the legal entity now, sir.
Yes,
All the
legal entity. Yeah.
Yeah, but no, sir, not once the reporting entity should be a company. So here is a sentence, not necessarily a legal entity like that. In the first line.
Yeah, it says that it not necessary for that to be a legal entity. If it is a legal entity, that is not a problem, right? So that's why they are saying that when it comes to this reporting entity, it can be a legal entity, or otherwise it may not, right? Because in accounting, what we highlight the most is that the substance. So therefore, it is always the substance can or cannot be the same as the legal form. So in when it comes to a company, it's the legal form and the substance, it is same. So therefore, it is a legal entity. But if you take a group of entity scenario, there the individual entities are legal entities. But as a group, you know, we prepare the group, the consolidated financial statement considering the group. But when it comes to this group, it is an economic entity. Economic entity in the sense, it is an entity that we created for the reporting purpose. So there is no any, we do not form that group of entities, isn't it? We are not going to incorporate that something.
Yes.
We are not going to do that. So we are
Understood.
considering that particular group
Understood.
that is for the
Yeah.
reporting purpose, right? So it is what we call the economic entity. And even the same applies if you take a kind of a, say, 30% of the interest in another entity. So there we identify that scenario as an associate. But again, when it comes to that associate, it is not a kind of legal entity. It is again an entity that we created for the reporting purpose. When we have a considerable interest, so we combine that with our entity, or the investor's entity, and then they report. So again, it is an entity that is created for the reporting purpose. It's an economic entity, right?
Thank you, sir.
So it's always need not to be a legal entity. Even we do not confine to the discussion of these companies. Even it can be kind of a sole proprietorship, the partnership, so even the other forms. So if those entities, even a sole proprietor, if he wants to prepare the general purpose financial statements, so he can do that. All what he or she has to do is to apply the general purpose, what do you call that, the Sri Lanka accounting standards. So if they apply all the three accounting standards, the requirement, and prepare the financial statements, and that is general purpose financial statement. So in that, it becomes a reporting entity, right? So therefore, we need not to confine that to a particular segment, but most of the discussion that is covered by the companies, right? And you have raised the question over the economic entity. I think it is now clear. It's about an entity that we created for the reporting purpose. Reporting purpose, the entity is what we create. Good. Okay, then coming back to the objective of this general purpose financial reporting, since we have talked about the general purpose financial statements. So this is something we discuss. So we are there to provide the financial information about the reporting entity to users in making decisions about providing resources to the entity. In simple words, we are there to provide the useful financial information to the capital providers to support them with their resource allocation decision. So that is what the objective that we have agreed in the conceptual framework for financial reporting. Then if you dig deeper into that, so you would find that if you question what these financial informations are, it is simply the economic resources and claims, information about the economic resources and claims, as well as the changes in the economic resources and claims. So the economic resources and claims, what we call the financial position, the changes in economic resources and claims that is communicated through the changes in, that is communicated mainly through the statement of profit or loss and other comprehensive income. So we call it the changes that is due to the financial performance, and from other events and transactions, that is about the statement of changes in equity. So the change in economic resource and claims is basically communicated through the statement of profit or loss and other comprehensive income and a statement of changes in equity. And if you want to see it from a cash point of view, you communicate that through the cash flow statement. Economic resources and claims is communicated through the statement of financial position. So likewise, I can remember we draw a kind of relationship between this in the last class. So this is about the objective of general purpose financial reporting. Then the financial statement, if you look at the objective of the financial statement as for LKS 1, it says that we want to provide information about the financial position, financial performance, and cash flows of an entity. You know, here we broadly discuss the objective of general purpose financial reporting. But if you narrow down that to the objective of the financial statements, you can say that this is going to be the objective. What is the objective of financial statement? They want to communicate about the financial position. If you think broad, This is it. And they want to talk about the financial performance. This is it. And the cash flows. Cash flow in the sense that is about the performance or the changes in the economic resources and claims in terms of cash. So that is about the changes in the cash flow. And also you can include here, it is about the changes in the equity, changes in the equity over a period. So that is about the other events and transactions. So that is about the finance. Sorry, my connection has suddenly lost. Now I have got it back, right?
The sound is broken.
Sorry?
The sound is broken, sir, continuously.
Is that so? Let me stop the video, right? I think it might help. Now would that be fine?
Yes, sir.
Can you hear me properly?
Yeah.
Yeah, right. Okay.
Yes, sir.
Right. Right. So last I was discussing about this objective of financial statement. It is simply the narrowing down the objective of general purpose financial reporting, right? Okay. So it's about the position, performance, the cash flows, and even you can add that is about the changes in equity, changes in equity. So that is about the objective of financial statement as per LKS 1 presentation of financial statement standard. Then here we have identified the complete set of financial statements. So we prepare the statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flows, and notes. So usually that is going to be the complete set of financial statements. But under extreme circumstances, together with the notes, we also have this comparative information in respect to the preceding periods. You would find that if you take a typical annual report, when you see the statement of financial position for the current year, the last year statement of financial position is also being provided. The same for the statement of profit or loss. Same for the changes in equity, cash flow, same. So therefore, comparative information is also an important part of the complete set of financial statement. But in extreme circumstances, you may see a third statement of financial position at the beginning of the earliest comparative period when an entity applies an accounting policy retrospectively or make a retrospective restatement of items in the financial statements. So if you find there's a kind of a policy change, or if there's a kind of error that you had identified, so in rectifying that, so you might see apart from the two statement of financial positions that you have, you will be having a third statement of financial position that is at the beginning of the earliest comparative period. So let's say that your year ends on 31st March 2021, then you would be having a statement of financial position on that particular date. Together with that, the comparative one comes on 31st March 2020. And if you have done a policy change, which has a kind of a cumulative impact that goes beyond the earliest comparative period. So in that, you would be having a statement of financial position showing the cumulative impact of this accounting policy change that is on 1st of April 2019. That is the earliest comparative period. So අද අපි ඉන්නේ 2021 3.31 නම් ඒතර අපේ earliest period එක වෙන්නේ 2020 3.31 එදාට කොහොමද තියෙන statement of financial position එක ඊට අමතරව ඒ period එක පටන් ගන්න දවස්. ඒ period එක පටන් ගන්නේ 4.1.2010. So on that date you are supposed to have a statement of financial position, right? So that's what it says over here. And this is what we call the complete set of financial statements. So that is in line with the LKS 1, right? So these are some of the general information what we discussed. So we want to discuss mainly on the reporting entity, but there's information that stems from that. We discuss about the objective of financial reporting and also the objective of financial statements. Together with that, the complete set of financial statements I have briefly mentioned. Then the second most important thing what I want to discuss in the day, the one thing is about the reporting entity. Now we have had a discussion on that, and it was clear that it is precisely being defined. It is an entity that chooses or is required to prepare the financial statement, or the general purpose financial statement is what we call the reporting entity. Then we come to the reporting period. So that is the second contemporary issue what we expect to discuss under the disclosures. So what is a reporting period?
According to the companies, 1st April to 31st March, normally the government entity every calendar year, December.
Yeah, 31st December. Yeah. So you are mentioning that is the reporting date. Yeah, good. Very good. Very correct. So 31st March and 31st December, usually that is the reporting date. The date we prepare the statement of financial position, that is what we call the reporting date. So when you come to the reporting period, yes, that is a kind of a 12-month period. So simply putting, it's a 12-month period. And you know, this particular practice, this annual taking 1 year as a reporting period, that particular practice has been there for a considerable period of time. Even it spanned more than 500 years, it says that. So this reporting practice, the standardization, so the annual reporting period is introduced to the world more than 500 years ago. So even it remains valid in the today's context. So the annual reporting period. So therefore, usually we are having a 12-month reporting period, or we can say it's a annual reporting period, right? And when it comes to this reporting period, you know, there are two set of parties. There is one set of party who would prefer to have this standardization. So in the sense, they are in favor of this 12-month reporting period. While there is other set of parties, parties who would question this standardization of the reporting period, given the limitations of the standardization, and they are preferring for a flexible approach to reporting period. So rather than going by this 12 months reporting period, they may be looking for a much more flexible approach. It always need not to be 12, it can be 9, or even it can be 15 or whatever. So likewise, they are looking for a flexible approach. So that is the debate that is going on around this reporting period. But more prominently, what we can see is that the standardization is promoted by the international accounting standards, as well as the, when it comes to the Sri Lankan context, Sri Lanka financial reporting standards. Sri Lanka accounting standards, basically we promote this standardization of the reporting period. So the accounting standards are in favor of the standardization, right? Then, so if you have to look, so as you think, so what are the arguments for this standardization of the reporting period? Why we should favor the 12 months reporting period, or why we should prefer, or why we prefer for an annual reporting period? What are the arguments as you think? So this is some of your common sense here. Need not to be precise. We may discuss as you think.
To comply with the tax act.
To comply with the tax reform. Yes, very correct. Yes, one of the main reasons, yes, that identifies in the literature, as you have said that. So that was because of the requirements of the income tax. So the tax authorities might require you to compile the financial statements on an annual basis. Yes, that is one thing. The other one, as you have highlighted, the encourage the comparison. Yes. So if you prepare the financial statements for standard periods, then it will allow the investors the opportunity to compare. So they can compare the financial statements of one entity with that of another, or even the financial statement of the same entity with that of the previous periods. So therefore, it helps the investors mainly the capital providers with the comparison. So the tax requirements and also uh, the comparison, yes, very correct. One is the demarcating factor for short-term and long-term periods. Yes, so that is also there. It's a kind of a short-term period and the long-term. Yeah, for the purpose of decision making, yeah, that sounds good. Yeah, so by looking at this financial statement, they are to make decisions, right?
Yeah, for calculating the investors' yield annually.
Yes, very correct. So another aspect is that it is about the rate of return. So the investors would like to see their return. So what is the return that is generated periodically? So that is another supporting factor. Yes, very correct. Identify the profit. They're the same as the investor's return. Good. So very correct. So in fact, that is what it is identified in the literature as well. You are perfectly correct. Encouraging comparison, near comparison, yes, we take decision making and the increase the harmonization. Yes, that is also a good observation. So, we are moving for a kind of global world. So in this global world that it is not just us. So it is the rest of the world even. So they would prepare the financial statements for standardized period. So in compliance with that, so it might promote the harmonization as well to evaluate the performance. Yes, very correct. And also just to add one thing that it is in fact included in what you have said, but to refine that, it's about the uh, assessment of the management stewardship. So the other day we discussed that. So you have, as the investors, the capital providers, you have entrusted your resources to the management. So at the end of the day, you want to see that how good they are managing these resources. So if you are receiving the results on a periodic basis, then you can see that how well they are performing. So it's about the performance evaluation of the managers, and it's about the decision making of yours, as you have very correctly highlighted. So in fact, those are the factors what the literature identifies as the arguments for standardization. So just to show that, just to visit that, here are the arguments for the standardization of reporting period. So it includes everything what you have said. The first one, it allows the investors to compare and evaluate the management of different reporting entities. The comparison, it facilitates the comparison as you highlighted, and also the requirements for dividend, right? So when it comes to the return, when it comes to offering a return for the investors, so basically you need to close down the books, you need to close the books and calculate the profit and declare a dividend. For that, you need to have a standardization. You need to do that in a periodic basis. And also the Companies Act, they would require the entity to prepare the annual financial statement. So there are regulatory requirements. I saw that even in that was highlighted. So the Companies Act, it's a regulatory requirement. So apart from these accounting standards, so this Companies Act would require the entities to produce the annual financial statement. So in compliance with this regulatory requirement also, the companies would have to do the same. And also as a control mechanism, it's about the stewardship of the management. So the investors want to assess the stewardship of the management, right? So these are some of the arguments, as we have very correctly highlighted, for the standardization, and this is getting more prominent. Hence, in the contemporary business environment, we would find that the standardization of reporting period over the flexibility. Good. Then it asks, what are the arguments for a more flexible approach to reporting period? What about what are the arguments? Then why we should not favor the standardization, or why we should prefer a kind of a more flexible approach rather than just going by 12 months reporting
So
period?
the quarterly annual quarterly return reporting also very important for the interim tax payment purpose and for making some controlling.
Yeah.
For the larger companies.
So even we would require a kind of reporting in between this standardized reporting. So between this annual reporting, we need a kind of a reporting, or as you very correctly said that it is the interim reporting. That is for the tax purposes. Sometimes it helps. And also the control purposes. Yes, that is a good argument. Yeah, we can take that. It is for the control purpose, the same purpose. We can highlight the control and also the tax purposes.
To pay interim dividends.
To be more timeliness, yes, that is also sounds good. What you said? Yeah.
To pay interim dividends.
To pay interim dividends. For that purpose also, you might require kind of reporting. Yeah. Okay, good. Very correct. That can also be taken. The historical data is presented in this report. After 12 months, it would be too late to make certain decisions. Yeah. So that is about the timeliness. Again, you highlight timeliness. Yes. So we can take certain arguments. We can't wait for 12 months reporting period because of the time constraints. The timeliness is a matter to concern the interim dividends, the control, the tax purposes. So in that, we may prefer for a kind of a flexible approach. Good. Then more quickly release of the information. Yeah, it's about the timeliness. Loans request the bank expect us to provide the financial statement more frequently. Yes, very correct. That's a good argument. So it's about the requirement of the capital providers. They may request us to produce the financial statements in frequent intervals. So we may have to think of. Even so here, I feel that we are more considering about a kind of lower period. But how about the higher period? In that sense, what about the reporting period of 15 months or maybe 18 months, something like that? That is also a part of the flexible approach. It's not just the reporting period being shorter, even it can be longer than the usual. So we were thinking more about, I feel that you're thinking more about a shorter reporting period. Then how about a longer one? Why we should prefer a kind of longer period? So if you think
business acquisition.
Sorry?
To business acquisition.
For business acquisition purpose. Can you little explain that?
Normally, when we go into acquisition, the business, we have to evaluate the financial figures and other.
So when you go for the business acquisition, we need to do a kind of evaluation. For that, yeah. So one sound argument comes, yes, appreciate your point, and the less cost involved in reporting with long frequencies. So that is also kind of a convincing argument. You know, when it comes to this, the annual report preparation and the whole reporting process, it comes at a cost. So if we are preferring for a kind of a longer reporting period, so usually it has some implication on the cost. So smart thinking, good. So less cost is involved in reporting, good. There are loans requested, bank expect us to provide financial report more frequently than 1+ year and projects are involved. Okay, the business ceases to exist after 1 year's period. Okay, good. So yes, there are very valid concerns. So really appreciate your thinking, right? So most of you are in the right direction. So I might say that, in fact, almost all the answers are in the right direction. So we can take them. So the control purpose, as you highlighted, and the dividends and the requirements of the capital providers, also the cost that involves. So those are some of the valid concerns that is raised. So hence, when you are approaching a question, even come to an examination scenario, you need not to confine what it was there in the slides. So in fact, when we are looking at the questions, we are not simply going by what is there in the slides or whatever the materials what we share. So it's all about appreciating your thinking. So if you can come up with a very convincing argument, convincing answer, that is in fact deserve the full mark. So therefore, when you are getting a typical question like this in case of the examination, don't hesitate, never leave that. Even you do not exactly know what it was there in the slides or something, you don't have to worry. So you come up with something on your own. It's about kind of a improvisation, right? So you come up with what you have then that is going to be correct. So here, what you have mentioned is mostly in the right direction. So it is pretty much appreciated. Yes. So when it comes to arguments for a more flexible approach to reporting period, so these are some of the aspects what we should have even considered. The one thing is that it says that when it comes to these standardized periods, it cuts across many uncompleted transactions and therefore require arbitrary apportioning of the operations and assets. So that is one of the problems in this standardization of reporting period. You know, especially when it comes to the revenue recognition, right? In line with the latest SLFRS 15, the revenue from contract with customers when it comes to these standards. So you would find that because of this standardization, because of these periodic concepts, so you might have to go for this arbitrary apportioning of the assets, arbitrary apportioning of the revenue involved. So that is all because of this periodic concept. So it is costly. So you may have to use these estimates, but we know the estimates, it involves judgment. So the instances where the judgment is involved, so it compromised to a certain degree, what I would say that the faithful representation. So in terms of the conceptual framework, it compromised the faithful representation to a certain degree. So therefore, we must prefer for a more flexible approach. So we need not to confine for like 12 months. We may simply go by that, and once these particular transactions are over, once we feel comfortable, once we feel that now it is ready for us to prepare the financial statement, we may prepare them, and that might communicate a very true picture, right? So therefore, that is one argument. So it may compromise or it would facilitate this arbitrary apportioning. And the other one is that it is argued that in the literature, it is better to focus on the natural earning cycle of the business. So here we find that almost all the companies are going by 31st March. But when it comes to the entities are different. They are different in terms of the operation, right? So when it comes to the plantation companies, when it comes to the construction companies, so when it comes to the other operation, the hotel sector, right? Their natural earning cycle is different. So especially if you take the hotels, they have the season, the off season. So if you take the plantation, there are periods where they cultivate, so where they harvest the produce, I would say. So likewise, they are very different in terms of their earning cycle. But all these parties are simply going by a reporting period of 31st March or something. So therefore, instead of doing that, if they focus on the true nature of their operations and true nature of their business activities, their normal operating cycles, so then they would have ended up with a better reporting than this. So hence, it is argued in the literature that better to focus on the natural earning cycle. And also at the same time, so when you are reporting on a periodic basis, when you are reporting for a shorter period, like 12 months or something, there is a tendency that the management is put on the pressure to produce the results. So in that, they may engage in short-term oriented earning management. So they may try to show a kind of profit. So sometimes that is by applying the accounting policies and accounting estimates. Sometimes it is not in the genuine way, but in a kind of a fraudulent way sometimes in the extremes to show a profit or a kind of a good picture in the short run. So therefore, management would be put under the pressure. So if you are reporting for a kind of a standardized period to come up with a good picture. So in that, the earnings management, the manipulations are possible. So therefore, this standardization would promote, in a way, the manipulation of the earnings. So that is also another argument what we put forward for this flexible approach, why we should prefer for a flexible approach. So updated performance, yeah. Good. So these are some of the arguments that is identified in the literature for a flexible approach. Together with that, the some of the valid points you have raised, you can add to that. The control, the profits, the performance, the requirements of the capital providers are some of the things that you have highlighted over there, right? So all in all, when it comes to the today's environment, we have witnessed that it is largely the standardization is there. So standardization is preferred over the flexible approach, but still the arguments are going on for the flexible approach as well. Yes. Yes, Nana Kara, you were trying to tell something. Right, if not, we can move on. It's about the interim reporting. Right. So what about interim reporting? So in fact, this is what we discussed earlier even. It's about the preparation and presentation of the financial statement for a period that is less than a full financial year. Or I would say that it is the reporting in between the annual financial reporting. So usually you report annually, the reporting that takes place between the two annual reporting, and that is the interim financial reporting. Reporting for a period less than 12 months, right? The reporting that is period less than 12 months. Typically, in our context, we see that it's the quarterly reporting and the biannual reporting we would see, especially when it comes to the public listed entities. We would find that the quarterly reporting and biannual reporting is there. And the one thing is that when it comes to this LKS 34, that is the interim reporting, the standard does not prescribe us to go for a reporting for interim period. The standard does not require us to go for an interim reporting. But when it comes to the interim reporting, that is promoted by the other regulatory requirements, especially when it comes to the public listed entities. So there's a requirement in the SEC, as per the SEC rules. So it would require us to report interim, for interim period, like quarterly reporting. Or sometimes it is the Companies Act may require us to report for a period like quarter or kind of biannual period. So therefore, interim reporting, it is not something prescribed by the standard itself, but it is by the other regulatory requirement, maybe the SEC rules and also the requirement of the Companies Act. But when these regulatory requirements would require us to go for the interim reporting and how it must be done, the required guidelines is provided by the LKS 34. Right? So මේ standard එකකින් අපිට කොයිම් වෙලාවකවත් අවශ්‍ය වෙන්නේ නැහැ. කොයිම් වෙලාවකවත් අපිට කියන්නේ නැහැ interim reporting කරන්න කියලා. ඒ interim reporting කරනවද නැද්ද කියන එක තීරණය වෙන්නේ යම්කිසි country එකක තියෙන regulatory requirement. So in our case, for the public listed entities, it is required by the SEC. The Securities and Exchange Commission rules would require to go for interim reporting, and even the requirements of the Companies Act. So there is a requirement. So once it is required, the LKS 34 says that how it must be done. So that's what the LKS 34 is. Is there a requirement to publish interim reports? Yes. When it comes to the public listed entities, the PLCs, yes, there is a regulatory requirement. So they would require to report that. So that's why we would find that the reports for 3 months, 3 months time, reports for 6 months time. That's why we see it's a regulatory requirement. So when you are going to do this interim reporting, in fact, you got two options. The one option is that you can prepare a complete set of financial statement. Like you do annually, you can prepare a complete set of financial statement. So the statement of financial position, profit or loss, changes in equity, cash flow, and the complete set of notes. So therefore, it is a complete set of financial statement. So that is one option you got. If you wish, you can do that. Or otherwise, you can do it as a condensed financial statements. So only very important information. So applying your judgment, deciding on the pretty much important information, you can do a condensed financial statements. So you can, when you come to the notes, you can go by some of the selected explanatory notes. So when you come to the statement of financial position, when you are showing the figures, so you can go by the pretty much important categories, right? The minimum required ones. So a statement of financial position would be the same. You need not, that need not to be comprehensive like complete set of financial statement, but it's rather a condensed financial statements. So most of the time we would find that when it comes to the interim reporting, the entities would take the second option, because preparing complete set of financial statement for every 3 months, it's not going to be practical. So it is a very costly exercise. So because of that, most of the entities would take the option, considering the regulatory requirement, they would go for the condensed financial statement. So very limited set of information, a limited set of financial information being made available. Financial information is made available. So that is the condensed financial statements. So later we may take or download a kind of interim financial report and see. Okay, download it from the CSC, and then you can see that what these condensed financial statements. Right. So before we move on to the next section, it's about the manipulation. Now it is 40 minutes past 4. So shall we have a break and continue? So let's break for 15 minutes. Now it is nearly 4:40. So shall we meet around 15 minutes, sorry, 55 minutes past 4? Right. So let's break and continue, right? Fine. So we've been discussing about the reporting period. There we mainly discuss the arguments for the standardization and also the arguments for a flexible approach. And then we discuss about the interim reporting and the two options that is available. So here you can actually access to the CSC website and select a particular company. Under that, in the financials, you can access the quarterly reports. So you can leisurely do that and see how this interim financial reporting has been done, right? So you may do that later. Okay, with that note, let's move on to the next area of today's discussion, that is about the manipulation of the reported earnings, right? This is also another concern. In fact, this is one of the major criticisms that the financial reporting is having. The financial reporting rules, regulation, so that may provide some room for the preparers of financial statements to manipulate their reported earnings. So we'll see what is this manipulation? What do you mean by this manipulation of reported earnings? So it says that it is the use of management discretion to make accounting choices or to design transaction to affect the possibilities of wealth transfer. So here the key term is that wealth transfer between the company and the society, maybe the fund providers or the managers. So therefore, if I'm to ask you that what is the very purpose of this manipulation? Why entities do manipulation of the reported earnings? From this definition itself, you can see. Why is that? Why we do manipulation? Yes, so what you're saying is partly correct, to show a higher profit. Then why we need to show a higher profit? What we try to achieve?
To reduce
showing a
the
kind of higher profit here.
to reduce
Sorry.
to reduce the profit by showing increased expenses.
Yeah. So the one
And
motivation is
sure.
that, yeah. So basically, you are talking about the two sides. Yes. So when it comes to this report manipulation, the vulnerable figure is going to be the bottom line. So the most vulnerable figure is going to be the bottom line. That is a profit. So when it comes to this profit, that it can be manipulated either way. So if you wish to show kind of a higher profit figure or an inflated profit, yes, you can do so. And at the same time, if you want to show a kind of a lower profit, yes, you can do so. So the either way it is manipulation. Either way it is manipulation. So my basic question is that why the entities would do manipulation? Why do they sometimes show a higher profit, or why they show a low profit? The reduced taxes, yes. The answer is there to a certain extent to misleading the investors or other stakeholders. Is that misleading? Or yes, to a certain extent it is there to show that the performance is good so that the management gives increments. Yes, that is there to attract investors. Yes, basically your answers contains what I expect. But in a simple word, I can say that why we do manipulation, that is to ensure the wealth transfer. That is for the wealth transfer. As I said, it is about the transferring wealth from the company to managers, as you said. So if the manager's compensation is attached, managers compensation is attached, or their performance is evaluated based on the profit, by showing a higher profit, what they are trying to do, they are going to take some wealth from the company to them. So therefore, it's a wealth transfer from the company to managers, right? So manipulation has supported the wealth transfer from the company to managers. Then at the same time, so if you are making kind of good profit, so at the end of the day, it is going to impact what you call the perception of the investors, especially the potential investors. So if these potential investors are continually seeing that the good profits being made by a particular entity, as a result of that, the share prices would go up. So then these new investors, when they are trying to purchase that, there is a wealth transfer from these new investors to the existing investors. Again, there is a wealth transfer that is in the society, right? That is from the society to investors. That is from the new investors to existing investors. So likewise, basically, in the manipulation, what happens is that it's a wealth transfer. And again, as you have mentioned that when it comes to this tax, by way of showing a reduced profit, sometimes you may ready to pay a lower tax. In that sense, so what the money that goes to the society, there's a reduction in the wealth flow. So therefore, you can in broad say that the manipulation is there to it affects the wealth transfer. So manipulation, they are what the managers would do basically, because they are the ones who prepare the financial statement. The management would have the access to more information. So that is the reality. So they have this inside information. So it's a moral hazard, right? But still, the managers, as far as a company is concerned, the managers are in a much more comfortable position. They have that inside information. So therefore, by using this inside information, so together with their judgment, together with their discretion, so they can make some policy choices. You know, when it comes to the accounting, so the different policies are there. So when it comes to transaction, so if you want to enhance the profit, if you want to inflate the profit, yes, by the choice of accounting policies, by making use of the estimates, you can enhance this profit. So similarly, you can design certain transaction. The artificial transactions can be created. By way of that, you can manipulate the profits. You can manipulate profits. So the managers can basically do that. So managers would do that to affect the wealth transfer. So sometimes they do that to take some of the profit to themselves. That is about their compensation, achieving the profit targets. So sometimes to promote the wealth transfer from the new investors to the existing investors, to the controlling investors. sometimes from the company to the society, like tax payment by way of reducing the tax. So likewise, the manipulation is supported to affect the wealth transfer. So when it comes to this manipulation, basically, we talk about, in fact, good manipulation as well as bad manipulation, right? So the good manipulation is basically what we call the earnings management. So the manipulation are basically two types. One is called the good manipulation, other one is called the bad manipulation, right? So manipulation is bad, but still there's a kind of a, depending on the severity, it is being classified as good manipulation and bad manipulation. So the good manipulation is what we call in broad the earning management. So it is basically within the law. You are not going to what do you call that, violate the rules and regulations. You are going to play the game within the rules. So it's about a kind of good manipulation. Then on the other hand, what is called the bad manipulation, that is about the frauds, the fraudulent activities, right? It is what we call the bad manipulation. So when it comes to this earning management, basically we identify there are three types of earning management usually we talk about. So the one is called the income smoothing, the other one is called the big bath accounting, and also the creative accounting. These are three main types of earning management. We'll discuss them later. And when it comes to the fraud, that is quite obvious. The fraudulent income schemes like changes in useful life and residual value estimates to meet the revenue targets, right? So it's a kind of a fraudulent type of activity. So it is a bad manipulation. But either way, the purpose is about the wealth transfer. Starting from what is said as the good manipulation, the earnings management. The earnings management, it depends on the timing differences arise between accrual accounting and cash accounting. So this earning management is possible because, if we are to adopt this cash accounting, it is more real. It is more real. The room for the earnings management would be quite less. But when it comes to this accrual accounting, there's a room for earning management. So hence we basically call that the earnings management depends on the timing differences arising between the accrual accounting and cash accounting. So as per the accrual accounting, the income is recognized when it is earned, and the expense is recognized when it is incurred, or in broadly speaking, when it is relevant for a particular period. But when it comes to the cash accounting, the income and expenses are recognized once it is paid out in cash. So when it comes to the recognition of income and expenses under the accrual accounting is different from the cash accounting. So because of that reason, so it has given some room for the preparers of financial statements to cook the books, so they can engage in kind of a earning management. In simple terms, what do you call this earning management? It is about bringing the revenue to the year of need and postponing the expenses to the year of need. It may be the next or the subsequent years. So it's about artificially identifying the revenue in the year of need and also postponing the expenses to the next or whatever the year that you would wish. So it depends. So whether you want to enhance the profits, so certainly you have to defer the expenses and increase the revenue. So if it is other way around, if you want to reduce that, then you may defer the revenue and recognize the expenses immediately. So whatever that is, depending on your purpose, so you can engage in a kind of a earning management. So it is what we call the earning management, and it is argued that depending on the severity, this is a kind of a good manipulation. So it is not severe compared to the fraud. it is not a fraud. It is by making use of the existing principles. So you are engaging in a kind of a manipulation. So under this broad heading, this earnings management, we identify, as I said earlier, three types of earning management. Yeah. Before we move on to that, we'll see why we do earnings management, why we engage in earnings management. In fact, this was discussed earlier, but here to further clarify that, you can broadly divide this earnings management motivation into two. So one thing is about the maximize the benefit to managers. So as managers, I told you that if their performance is evaluated based on the profit, right? If their compensation plans are linked to the bottom line, so certainly there is a motivation for the managers to engage in the earnings management. And at the same time, there could be another motivation that is about benefit of the entity. In that sense, benefit to the shareholders or the dominant shareholders, the benefit to the investors. So the one thing is that it is about meeting the expectation of the shareholders and analysts. You know, by looking at the company's performance, basically by looking at the company's performance, this analyst, the financial analyst, basically forecast the performance of an entity. By looking at the past performance, they would predict the performance of the entities. So then what the managers are trying to do is that in line with this forecast, what these financial analysts are making, we are trying to keep our profits in line with that. So therefore, it is argued that when it comes to the earnings of an organization, it may not reflect the strategies of the business, but instead it would simply represent the expectation that the shareholders and the financial analysts would have on the entity. So they would form the strategies to ensure that their earnings are in compliance to the forecast made by the financial analyst. So සාමාන්‍යයෙන් අපි කියනවා දැන් අපි සිද්ධ වෙන්න ඕනේ සාමාන්‍යයෙන් ආයතනයක earnings ගත්තාම ඒ earnings වලින් represent කරන්න ඕනේ ආයතනයේ තියෙන strategic position එකක්. ආයතනයේ තියෙන strategies වගේ strategic information තමයි reflect කරන්න ඕනේ earnings ගත්තාම. නමුත් ප්‍රායෝගිකව සිද්ධ වෙන්නේ මොකක්ද? ආයතනයක managers ලා කරනවා කියනවා sometimes financial analyst ලා ආයතනය සම්බන්ධයෙන් කරන predictions බලලා එතකොට මේ strategies හදනවලු ආයතනයේ earnings හරියටම අර forecast වලට සමපාත වෙන විදිහට ගන්න. So therefore that is how the strategy is being formed. So it is not reflecting the strategic position of an entity, but rather it simply represent or the strategies simply represent the forecast that is being made by the financial analyst. So there is a motivation that the managers want to keep that the entity's performance is in line with the predictions that is being made by the financial analysts. So therefore, they want to achieve a good share price at the end of the day, right? So that is to please the dominant shareholders. And the other thing is about, so when you are keeping your performance in line with the forecast, so obviously the market respond, so that would lead to the maximization of the share price. The share prices would go up. So as a matter of that, the company valuation. So that is another motivation for the earnings management, and also to avoid violation of debt covenants. So when you obtain certain loans, so sometimes there would be requirements as such that your share price has to be maintained something like this at this particular level. So in order to ensure that, so sometimes you may engage in earnings management. So when you're doing so, so you can avoid the constraints that is being placed by the capital providers, especially the debt capital providers. So therefore, that could be another motivation. So likewise, there would be certain. So hence, the earning management is accomplishing a kind of a broader purpose, that is the wealth transfer But in order to do that, the managers would be having different motivation. So they want to maximize the benefit for themselves as well as the shareholders or the investors, or we'd say the entity, right? Then when come to the major forms of earnings management, the first one we take, it is about the income smoothing. So what do you mean by this income smoothing? So it's about the management artificially manipulate earnings to produce a steady growth profit stream. So here basically, as I said, that earning management is not bad at all. So here you can see that through the manipulation, what they are trying to achieve is that it's a steady profit growth. In doing so, what they basically do, so in the periods where you have some higher profits, we call it above normal profit. In the periods, in the good times, right, when you have some good profit, what you are going to do is you are artificially reducing these profits. Say that usually you are making per annum profit of 10 million. So in a period where you would receive, say, 18 million or something, you are not going to show that your profit as 18 million. But instead, you may show your profit as 12 million. And you may keep 6 million. You may put it as a kind of a provision, and then you may set that particular amount aside, right? So therefore, in the times that you are doing really good, you're not going to show that entire profit, but instead you are going to show a kind of a considerable profit figure. If you are making 18 million, and usually if you are making 10 million, you may show 12 million, and you are keeping that 6 million. Then when you are going through some bad times, so let's say that in the very next period that you are making some kind of a you're not making some good profit, let's say that you are making like a profit of 4 million or something, then you can use that 6 million that you have put into that provision, and you can utilize that, and in the next period you can show a profit of again 10 million. So that is what we call the income smoothing. So here basically it is argued that this is not a bad practice at all. The reason is that so here they are not artificially creating some profits, right? They have profits, but they are consciously or they are deliberately maintaining some provisions, and they are keeping that profits aside, and when the time of need comes, they are simply utilizing that. So hence there's nothing much wrong in that. तर මෙතන මේ income smoothing වල basically අපි කරන්නේ අපිට හොඳට profit තියෙන කාලවල වලදී ඒ profits ටික provisions විදියට අයින් කරලා තියා ගන්නවා කොටසක්. ඒතර නරක කාලේ එනකොට ඒ provisions ටික ඒක use කරලා utilize කරලා අපි අපේ profit figure එක steady growth එකක් පෙන්වන විදියට අරගෙන යනවා. It's a manipulation, no doubt, but there's no much harm in that, I would say. So that's why it is said that earnings management is a good manipulation. So when comes income smoothing, so considering the severity, the impact, so it is kind of a less severe endeavor. Then similarly, we talk about another form of earnings management, and we call it's a big bath accounting, or we call it taking a bath. So there what happens is that when an organization, a new management team is appointed, right, replacing the existing management, what they are going to do, they are going to deliberately reduce the profit, right? They are going to income is more, yeah. So I'll come to that later. Good, right? So let me explain this big bath accounting, and let me come to that, right? So here, when it comes to this big bath accounting, what I was saying that when a new management team is appointed, replacing the existing management, what this new management team would do, they are going to deliberately reduce the profits. So in the existing time period, in the period where they undertook the business, they are going to use some income decreasing accruals. They try to reduce their accruals income as possible, and thereby they try to reduce the profit. Then what they are going to do, this reduction of profit, they put the blame to the old management. They say that this is because of the previous management. So because of their mistakes, see what has happened, our bottom line has gone down. Then at the same time, they are getting the comfort that they know for sure, so they have done this deliberately in the periods to come. So once they simply get rid from these income decreasing accruals, so they may simply make into a good profit figure. Thereby, whatever the targets that they've been assigned, whatever the targets being assigned to the management team being achieved, so therefore they are getting a huge compensation, right? As well as so their targets are easily achievable because they know they have deliberately reduced the profits. So therefore, their targets are quite achievable. And once they achieve the targets, they are also getting a good compensation. And that is called the big bath accounting. And again, it is a kind of a earnings management form, so which is considered kind of a good manipulation comparatively. So that is the second form of, yeah. The third one, there what we had is that creative accounting. So it is not being taken over there, but creative accounting also, what we would do that we are making use of the provisions and we are making use of the estimates, and then thereby we are making some profit figures. So again, we are doing the things within the rules and regulation, within the accounting standards, by exploiting whatever the judgments that is allowed in the accounting standards. So we are making use of that and making some profit, then you have raised a question, good question. What is that? You asked that when it comes to this, to show that performance is good so that management gets increments. How do we show the accounting treatment in the financial statement about income smoothing? So, you know, when it comes to this income smoothing, there is no one such treatment, right? You can think of creative ways of retaining the profits. So if I'm to give you one example, when it comes to this income smoothing, so if you find that you are having some good profit in the periods, what you can do is you can increase the amounts that you would take for, say, warranty provisions. So the amounts that you would set aside for warranty provisions, you can enhance the amount. So අපිට හොඳ profit තියෙනවා වගේ පේන period එක අපිට profit අඩු කරන්න පුළුවන් ලේසිම ක්‍රමයක් තමයි අපේ warranty provisions වැඩි කරනවා. So warranty provisions වැඩි කරනවා කියන්නේ in one side it creates an expense, on the other side it creates a provision. So provision එක වැඩි වෙලා expense එක වැඩි වුණා අන්න profit එක අඩු වෙනවා. So when you see a period where you do not make some good profit, what you can do is you can reduce the amounts of the provision. Provision එකේ තියෙන amount එක ඔයාලට අඩු කරන්න පුළුවන්. Provision එකක් අඩු කරනවා කියන්නේ expense එක අඩු වෙනවා, ඒ පැත්තෙන් වියදම වැඩි වෙනවා. අපි හිතමු මිලියන 6කින් ඔයා provision එක වැඩි කරගත්තා කියලා. In the time that you are having some good profits, so then your profit would reduce by 6 million. Then when you are having some bad times, what you are going to do, you are going to reverse that provision, right? It's all about the judgment, right? So the provisions are based on the estimates. In the instances where the estimates are there, you can hook the books. So you can reduce that and you can show higher profit figure. So that is one instance. ඒ අපිට income smoothing කරන්න පුළුවන් එක විදිය by making use of provision. And the other thing is that if you think of the PP, the depreciation, so think about the estimates. So you know there we use different estimates, the residual value estimates, the useful life estimates. So if you really want to reduce the profit, what you can do is you can increase the depreciation. Then how you can increase the depreciation? The one thing is that you can reduce the useful life. So if you review the useful life and if you reduce that, then you can increase the depreciation. So if you increase the depreciation, what happens is that your profit goes down. Then in the times where you want to increase the profit, then what you can do, you can again review your useful life and you can have a longer useful life. If you have a longer useful life, then automatically the depreciation comes down. So what it does, so it will create some profits. So likewise, you can think of the instances in the accounting standards where the judgment is permitted, especially the provisions, especially the estimates. So in such instances, you can exploit. In such instances, you can exploit. So you can go for revaluation, right? So think about those instances. So therefore, there are plenty of avenues are available for a entity who would wish to do this income smoothing. So the thing is that those are within the law, right? So the accounting standards, they try their maximum possible to reduce the judgment, but still there is a room for judgment. Still there is room for professional judgment in the instances where the judgment is involved. So if it is used in a wrong manner, I would say, if it is wrong, used in the wrong manner, yes, it is possible to make some manipulation. If you take this, the large scale scandals the world has gone through, everything was because of this high profile, the professionals. So they were involved. So if you take this famous, the Enron collapse, right? So if you take the WorldCom, so likewise, whatever the collapses, the corporate world collapses that has gone through. So partly it was, or the mainly it was due to the professionals involved. So that is because of their judgment. So that's it. Right, income smoothing, that is one form of that. And the big bath accounting, I think it is clear that you're trying to deliberately reduce your income and trying to create a higher profit figure, sorry, lower profit figure initially, then put the blame to the previous management, and then thereafter you are going to normalize the activities and have the enjoy the usual profits, but you are going to present them as something extraordinary that was due to your effort that was gone into that. Right. Then we discuss about the creative accounting. Again, in the creative accounting, what you make use of the judgment and the estimates provisions. So by making use of that, you may be creating some profit, or the periods where you need some loss, you can still create that. Right. Then the frauds, I think there is nothing much to discuss. It is something wrong. It is something wrong. So it is fraudulent activity. It is not something within the law. It is outside the law. You are simply doing something wrong. Right. Then it asks, what are the common earnings management practices followed in Sri Lanka? So if you are just heard of, you just aware of, yes, we can discuss. So what are the common earnings management practices that is followed in Sri Lankan organization that you were aware of? Anything to add? And again, anything to clarify from section what we discussed? It's about the manipulation of reported earnings. Now it is time. මොනවද සාමාන්‍ය ලංකාවේ තියෙන earnings management practices? Income smoothing, that particular practice being observed. So then you can be specific that like how so that particular thing has been carried out. What was the ways, the smart moves that they have taken, if it was evident, even in case of an audit or something, if it was witnessed. Yes, there can be some cases where when the audits are being performed, this manipulation of earnings might have been reported, might have been disclosed. That is possible. If any of you are having such kind of experience, or even if you heard of, so we can think about what those instances are. The earning management, yes, income smoothing. So the one classic way that we can do this income smoothing, as we discussed, it's about that provision. We can use the provisions smart and the estimates. Under what category? Creating deliberate strategic SBUs, stand for strategic business units, comes, right? The SBUs stands for strategic business units. Creating strategic, deliberately creating strategic business units. Yes, there is also kind of, we can think of, it depends on the severity. Sometimes the only question that you have to raise is that whether it is within the law or not. If it is permitted in the law, then it's a kind of good manipulation, earnings management. If it is not permitted within the law, then it is a fraudulent one. I think deliberate strategic business units, if it is permitted, so that is the concern we should come, whether it is permitted or not. If it is permitted, yes, it is manipulation, but it is considered to be good. At the one is it's bad, right? So manipulation is anyway bad, right? We know, we have that understanding, but still, depending on the severity, what it does, so we are classifying that. And even, so there can be instances, even this big bath accounting, that would have been there, no? So even most of the restructuring, so when the management is appearing, so it's always, when I have such experience that, so when I was doing the master's thesis, so one of the entities that I have investigated, or one of the entities that I have examined there, they have recently undergone such kind of management change. So the management team has been changed, and they were placing lots of blame on the previous management of not making adequate profits. And once this management has come into place, that they managed to make some good profit, things as such. That was a kind of experience that personally I might have. The revaluation, yeah, that could be another thing that could, so especially when it comes to this revaluation, most of the time, if it is gains, it would affect that other comprehensive income part most of the time. But still, yes, revaluation can also be considered if you really want to reduce the losses, because the revaluation loss would straight away go to the P&L. So therefore, if you want to show kind of a lower profit figure, so you can use this revaluation, because the revaluation loss goes to the P&L. Yes, so in a way we can accept that. Take one-time corporate grants, non-recurring, that received over time to time. One-time corporate grants. So when you receive these grants, it's non-recurring nature, but in reality, it's received over time to time. Okay. Then impairment of assets. So there is also a room. So for this impairment, it is where the judgment involved again. So by way of that, by way of the impairment of assets, you can affect the profits. Yes, good. So simply putting, here what we can do is overstating account receivable. How can we overstate the account receivable usually? Are we going to over invoice our debtors? Over invoice the debtors? Would that be the case? Yeah, in that way, it affects your sales as well. So therefore, the top line goes up. Yeah, changing accounting estimates. Yes, that is another sensible way of doing that. So likewise, so here if I'm to give you a kind of broader guideline, it's all about thinking about the instances where the professional judgment is involved, or would say the accounting estimates provisions involved. So in that, you can engage in earnings management. Then how does this earnings management impact on the fair presentation of the financial statement? How does that affect the fair presentation of financial statement? Obviously, this manipulation, it's something wrong, right? You're doing something wrong, the manipulation. So hence, if you think it in terms of the fundamental qualitative characteristics, so which of the qualitative characteristics that get affected the most because of this earnings management? So is it the relevance or the faithful representation? What is getting compromised if you engage in earnings management? The earnings management, yeah. So it is the faithful representation. You are supposed to represent the phenomena what it purports to present, but you may be presenting that is not the true phenomena, isn't it? You are showing a artificially created situation. You are deliberately created a situation which is not the true phenomenon. So which is not the true phenomenon or the substance. So which is different from substance. So it is something deliberately created one. So hence it affects the faithful representation. So it is obvious the earnings management, though it is argued that it is not, it is good, but it is a kind of a misrepresentation of the entity. It's a misrepresentation of the phenomenon for sustainability of the entity and to ensure the going concern. So it affects the going concern of the entity here. So in the long run, even it can affect the going concern. So especially if you engage in this, the big bar accounting. So if you engage in this income smoothing, right? So sometimes it might even compromise the going concern. So we can agree that it will affect the faithful representation. So how does it affects? As we discussed, it does not present the true phenomena. So when it is representing a phenomena other than the true phenomena, that is how it affects the true fair presentation. You can explain on that. Right. Now we come to the other important aspect. It's about the exclusion of activities from the financial reporting process. So we discussed that that is another contemporary area. It is another contemporary issue. So, when it comes to the financial statements or the financial reporting, we are predominantly talking about the financial performance. And we may simply ignore the reporting, the social and environmental impact of the business organization. And also another concern what we have is that, especially when it comes to these intangible assets and the intellectual assets, there are tight rules for recognition. So the recognition, so the existing ones, this probability and the reliability criterion are quite tight when it comes to the intangibles and intellectual assets. But when it comes to a business organization, one of the most important assets maybe they are intangible or the intellectual assets. In the present business world, we argue that only the 15%, nearly 15% of the market value is represented by the physical and the financial assets. So our financial capital, our manufactured capital, or we call it our PP, our assets, our asset base, would represent only the 15% of the market value. So the rest, that is 85% of the market value of an organization is represented by the intangibles. So that is what one of the most recent findings of a study carried out by SEMA. So they identified that more than 85% of the market value is represented by the intangible assets, the intellectual assets. So out of that, they identify the most important assets. That is going to be the brand names, the customer satisfaction, the systems that an organization would have. So likewise, almost all these assets are considered to be the most important value drivers. Those are intangibles, right? But the problem is that when it comes to the financial reporting, we are predominantly reporting on this physical asset in the sense PPE and the financial assets, maybe our investments. So traditionally, we are reporting on or what we report would account for only 15% of the market value of an organization. So if you think about the value relevance, 85% of the value drivers is not being communicated through this financial reporting process. We do not talk about the human capital. We don't have that flexibility. We can't report on the human capital or the human asset. We can't report our brand name, right? We can't report whatever the customer satisfaction, right? So the customers are getting, and the relationship, our social relationships, we can't report on that. But these are most important value drivers. So therefore, these activities are being largely ignored in the financial reporting process. So the criticisms are being placed. But the good thing is that in the present environment, so these aspects are being identified, and also through the different reporting mechanisms, especially the integrated reporting, especially the sustainability reporting, these challenges, these criticisms have been addressed to a larger extent, right? So this is another contemporary area. Yes, this is what I was telling, that when it comes to the market value of an entity, the book value of an entity is largely different. There's a huge gap. As I said, more than 85%, of the market value is not communicated through the asset that is being reported in the traditional statement of financial position. So the book value of an entity is largely different from that of the market value. And this is represented by the unrecognized intangible assets. The brand name, the reputation of the business organization, the human capital, right? The customer relationships. These are the important assets. And even some of the intangibles, yes, the brand name, it is itself an intellectual asset. So those are what represent the difference between the market value and the book value of an entity. So if you have to just talk about this intangible asset, when it comes to the LKS 38, the accounting standard that defines what is an intangible asset. So as they defined, it is a very rigid definition. You can see that it is identifiable non-monetary asset without physical substance. And that is what we call the intangible asset. So what fits under this definition is considered for recognition. So therefore, the definition itself is a very rigid one. So hence, it limits the number of intangible assets that a business organization can recognize. It will limit, the definition itself would limit the intangibles what we can recognize. We cannot recognize, there are certain intangibles what we cannot recognize. No? So if I'm to take that, you can see the internal generated goodwill, we are not allowed to recognize. The internal generated brands, we cannot. The publishing titles, the mastheads, the customer list, item of similar substance, all these are not eligible for recognition. So that is because of the definition and recognition criteria applicable to the intangible asset. So it is largely being ignored. So that is, in a way, one of the limitations of the financial reporting. The financial reporting, the traditional financial reporting would limit the recognition of intangible asset, but they are pretty much important when it comes to the market value of an entity. Those are very important value drivers. The brand name of an entity, the goodwill, those things matter a lot. but it is not allowed to be recognized under the traditional financial reporting. So when it comes to these intangible assets, the key characteristics are the identifiability, the control over resources, the existence of future economic benefits. So all these things would have a particular meaning. So if you take a kind of identifiability, what do you mean by this identifiability? The standard says that for a particular intangible asset to be identifiable, it has to be either separable or it should arise from the contractual or other legal right. This is what we call the identifiability. You can see that in the definition there it contains identifiable. And this is what the identifiable. It must be separable in the sense you must be capable of being separated. It must be capable of being separated or divided from the entity and sold, transferred, licensed, rented, or exchanged individually or together with the related content. So if you are to identify a particular intangible asset, it must be capable of being separated from the entity and it is being sold, transferred, licensed. So if you take a particular copyright, yes, it can be intangible. So if you have a copyright for a particular product or a process or whatever, yes, it must be separable. And you can have a patent. So it is also something which is separable. So likewise, you can think of some of the intangible assets. And even if you have a kind of a software that you even internally developed, but still it can be sold separately, right? If you invent particular technology, for that if you obtain a particular patent, so that is also a kind of a separable thing. So therefore, one of the conditions or one aspect of this identifiability mean it has to be separable. It must be capable of separating from the entity and sold, transferred, licensed, or rented or exchanged, right? That is the separability. Then on the other hand, even the intangibles can arise as a matter of contractual or other legal right. Say for an example, just think about a trading license. If you take a kind of a restaurant or a broadcasting organization, so let's say it's a television broadcasting organization or a kind of a radio broadcasting entity. So there they have a license. So they have a license to operate, right? So in that, that particular license, it is not separable, right? So therefore, it cannot be captured by this particular criterion. The separability is not there, but still it qualifies as an intangible asset. When it comes to the operating license, it comes at millions or even billions, right? That particular intangible asset can be recognized, even though it is not separable. The reason is that because it arises as a matter of contractual or other legal rights, right? So therefore, when it comes to this intangible asset can come into existence by way of two, it is either separable or either it arises from the contractual or other legal right, right? එතකොට intangible asset එකක් කියන එක මේ ආකාර දෙකෙන්ම ඇති වෙන්න පුළුවන්. එක්ක එක separable වෙන්න ඕනේ. එහෙම නැත්නම් ඒක contractual or legal right එකකින් එනවා නම් ඒක separable නැති වුණත් කමක් නෑ. දැන් උදාහරණ classic example එක තමයි trading license එක. Right? You can think about a trading license. It is a intangible asset that is eligible for recognition, right? So it's about the identifiability. Then the control, the second most important concept when it comes to this intangible asset. It is to power to obtain the future economic benefit flowing from the underlying resources and also to restrict the access of others. So it has basically two aspects. One thing is that you must be having the power to obtain the future economic benefits out of that. And the other one is that you must be able to restrict the others from accessing that. So if you have a copyright for a particular product, say that you are a kind of entity that produce movies. So if you have a copyright, that movies cannot be accessed. So if you are a book publisher, so if you have that copyright, you can restrict the access of others to this future economic benefits. So therefore, you have the power to obtain the benefits and also the restrict. The patent would work in the same way. If you invented a particular technology, if you have obtained the patent for that, so you can restrict the access of others. So you have that particular capacity. You have the power to obtain the benefits as well as others from access. So if you take the franchise agreement, would do the same. So if you take a operating license, would do the same. So it's about the control. The capacity of an entity to control the future economic benefits normally stem from legal rights that are enforceable in a court of law. So usually this control comes with the legal right. It comes with a legal right. So if you have a patent, so it would give you a kind of a legal right. If someone has violated, yes, you can take actions against you, right? Then when it comes to the internally generated intangibles, as I discussed, you can internally generate some systems, the processes, some technologies, and softwares. So these things can be generated, especially if you think about the vaccine. So nowadays, the most popular one. So the invention of a vaccine for the COVID-19, right? So in that, the lot of research would have gone into that. So lots of research would have gone into that, right? So when it comes to this internal generated intangibles development, basically we divide that development into two phases, the research phase and the development phase. So whatever the expenses that you incur in the research phase, we are instructed that it must be recognized as expenses. Once it is getting to the development stage, yes, you are allowed to capitalize the expenses in that research phase and the development phase. So therefore, in the research phase, it is just about searching for the knowledge, we call it. It is searching for the new knowledge. In the research, what we do, we are look for the new knowledge. But when it comes to the development, it is more tangible. So it is about the application of the research findings, right? So whatever the expenses that you do in the research phase, the economic benefits are far from certain. So I would say that the economic benefits are far away. So because of that reason, it is said that whatever the expenses that you would incur in the research phase to be expensed. But when it comes to the development, it is about the application of the research findings. So therefore, we can go for a more tangible thing. So once you've done research heavily on this vaccine, and once you find some possibilities, and then you can take that to the development. So whatever the expenses that you do in the development stage, that can be capitalized. And that is about the distinction about the internal generated intangibles. So this is some of the key aspects in the standards I'm just taking you through about the intangibles. So ආයතනයක් ඇතුලේ අපි හදන දෙයක් internal generated intangibles වෙනවා. ඒක system එකක් වෙන්න පුළුවන්, ඒක process එකක් වෙන්න පුළුවන්, procedure එකක්, නැත්නම් software එකක්, anything, technology, whatever, right? Then we develop that into two phases, the development of internal generated intangible, research based development phase. Research phase එකේ දරන expenses ඔක්කොම expense කරනවා, development phase එකේ ඒවා අපි capitalize කරනවා. So then how do you decide a particular development, internal generated intangible has come into the development phase? So the development phase එකට ආවා කියලා අපි කියන්නේ කොහොමද? So there it need to demonstrate all of the following. All of the following has to be demonstrated for a particular intangible asset to be claimed as it has entered into the development phase. The technical feasibility, intention to complete and use, ability to use or sell, how the intangible assets will generate probable future economic benefits, the availability of adequate resources, the ability to measure reliably expenditure attribute to the intangible asset. Likewise, all these conditions need to be satisfied. So then only we can say that it is in the development phase. So in other words, what they are trying to do is they are trying to minimize the amount that is allowable for capitalization. So මේ හැම දෙයකින්ම අපිට කියවෙන දේ තමයි intangible assets සඳහා අපිට capitalize කරන්න දෙන expenses අඩු කරන්න තමයි මේ standard එකේ ගොඩක්ම උත්සාහ කරන්නේ, right? So having placed this much of conditions, once all of these conditions are met, then only you can recognize the intangible asset. So therefore, you can see now you can understand or appreciate the rigidity involved here. So it is quite rigid. So the recognition of the internal generated intangible, it is quite rigid. What is availability of adequate resource? Yes, good. So here, availability of adequate resource in the sense that, so think about that vaccine. If I take that example, so in order to do this vaccine, you might need certain ingredients. No? The certain ingredients would be required. So those availability of those ingredients. So that is what we call the availability of resources. You need to have that manpower. So you need to have that required number of scientists. You need to have the required number of PP items, in the sense the machinery, whatever the machinery that it takes. You need to have the raw materials. So likewise, whatever the things that would take for the development of that particular product, process, or system. Since it's a vaccine, for the development of that, for that vaccine, whatever the resources, the manpower, the machinery, and the materials, whatever that is required, that must be in place. That is what we call adequate. And together with that, the money matter. So you need to have money to acquire all these things. So it is about kind of availability of the resources. Good. So likewise, whatever the question that you may have, you might think and question, right? Then I think rest of the things, it is clear. No, technical feasibility, it's about it is something doable, in simple words. So it is something technically feasible. It can be something that you can do. Then you have the intention to complete it, use it, or sell it. So if you are going for a vaccine, definitely you have intention to complete and sell it, and ability to use it or sell it. Then it must be it must be able to use. It must have to have that ability to use. And the intangible asset will generate probable future economic benefits. You need to show that it is going to generate some future cash flows. You need to forecast the cash flows and show there's a possibility. So certainly if a vaccine is invented for this COVID, so certainly it's going to generate the millions or even billions of cash flows. Then ability to measure reliably the expenditure attributable to the intangible assets. Likewise. So all these things, what you need to appreciate that, you know, when it comes to these aspects, so in case of your examination, these aspects may not be tested for sure, but here these points are being explained. That is just to show that the rigidity involved in the recognition of internally generated intangible assets, right? So have appreciation on that. That is the story what we are trying to tell. Then the non-recognition of internally generated intangible assets. So this is what we have taken earlier. It says that the goodwill you cannot recognize. The internally generated goodwill is not allowed to be recognized because it is said that you cannot measure the, you cannot reliably measure the expenditure that you incur to generate this goodwill. That is the argument that is put forward. So the standard එකේ කියනවා මේ internally generate කරපු goodwill එක recognize කරන්න බෑ. මොකද මේ goodwill එක ඇති කරන්න අපි දරපු වියදම කොච්චරක්ද කියලා අපිට reliably measure කරන්න බැරි හින්දා. Then it says that brand, just again, internally generated brands cannot be recognized. Again, the argument put forward, it says that you cannot distinguish the cost that you have incurred to develop this brand itself. So මේ brand එක develop කරන්න කියලා ඔයා වියදම් කරපු ප්‍රමාණය වෙන් කරලා අඳුන ගන්න බෑ කියනවා. ආයතනයක් වශයෙන් අපි සමස්තයක් වශයෙන් තමයි ආයතනය දිනු කරන්න වියදම් දරන්නේ. ඒතකොට ඒක ඇතුලේ goodwill එක තියෙන්න පුළුවන්, brands තියෙන්න පුළුවන්, customer relationships likewise විවිධ දේවල් තියෙන්න පුළුවන්. ඒ නිසා ඔයාට හරියටම කියන්න බෑ brand එක develop කරන්න ඔයා කීයක් වියදම් කරාද කියලා. So because of that issue, it says that the internally generated brand should also not be recognized. The mastheads, same argument. So you cannot say specifically say that how much you have incurred to develop the mastheads. The publishing titles, no. Customer list, no. Likewise. So therefore, you can see to a large extent, the recognition of intangible assets is restricted. Similarly, when it comes to the intellectual asset, the same. So the intellectual asset basically, it includes the following: the capital created by the employees or the purchase, such as the patent, computer and administrative systems, concepts, models, and research and development. You know, when it comes to the accounting standards, to a large extent, whatever the things that you have purchased, those are the intangibles that you have externally acquired, can be recognized. So the softwares that you have purchased, and also the patent, what you would acquire, for those things, yes, you are allowed to recognize. And when it comes to research and development, the internal generated intangibles, the development phase expenses can be capitalized. So therefore, the accounting standards allow only acquired intangible assets to be recognized. Then the next one, it is about the relationship with the customers and suppliers that consist of brand name, trademarks, and likewise. You know, the brand names, trademarks, they cannot be recognized. The customer relationships, no way, you cannot recognize. Then the capital embedded in the employees, such as through education, training, and value development, no. So broadly speaking, human capital, social and relationship capital, and this is also a kind of intangible assets. No, so out of these three categories, you know, only the acquired, externally acquired intangibles can be identified. When we acquire brand name or goodwill, we are putting as intangible asset, but intangible assets not recognized as. What is the reason? Yes, good question. Yeah, you know, when it comes to the business combination, as you have very correctly said that, yes, we are allowed to recognize the goodwill. And even if you have the brand, yes, that is allowed to be recognized. So taking it as a externally acquired thing. So in that, that itself talk about inconsistency in the recognition. So in the other day, even I touched on that. You know, when it comes to this business combination, the SLFRS 10 and the SLFRS 3, the business combination, that standard argues that when it comes to a business combination, if you can place a fair value on an intangible, yes, you can recognize. Then you don't have to worry about the flow of future economic benefits. If you can measure them reliably, if you can place a fair value reliably, then you can recognize. So that is the purpose why we are allowed to recognize the brand name. When you acquire a particular entity, if that particular entity has a brand name, if you can value that, if you can give a fair value for that, yes, you are allowed to recognize. So when it comes to the goodwill, it is said that it is a kind of a residual. So if you pay more than the value of the net assets, yes, the difference can be recognized as the goodwill. So that is the case when it comes to a kind of acquisition scenario. In that, there itself, there is a kind of a inconsistency in the recognition principles. But what they highlight is that if you can place a value, fair value on that, yes, you can do. Similarly, as you raised, when it comes to the internally generated goodwill and brand name, why we cannot recognize, that's what I even explained earlier. When it comes to that, it is said that you cannot reliably measure the cost that you have incurred to generate this goodwill or the brand. එතකොට මෙතනදී ආගියුමන්ට් එක තමයි අපි ඉන්ටර්නලි යම්කිසි goodwill එකක් brand එකක් create කරනවා නම් ඒ වෙනුවෙන් අපි දරපු වියදම අපිට reliably measure කරගන්න බැරි. We cannot reliably measure the amount that we have incurred to develop the goodwill. අපි ආයතනයේ goodwill එක හදන්න කියලා කීයක් වියදම් කරාද කියලා අපිට measure කරගන්න බැහැ. අපි brand එකක් හදන්න කියලා කීයක් measure කරාද කියලා අපිට reliably measure කරගන්න බැරි. ඒ හේතුව නිසා තමයි internally generated goodwills are prohibited. So that's what it says. So you cannot reliably measure the cost of developing each of these assets, right? Good. So it's a good question. I think I have answered your question. Yeah. Then moving further, I told you that now it is pretty much clear that the traditional financial reporting has failed to capture most of the intangibles. So therefore, it is a criticism. So there is a criticism of this very conservative approach that is being adopted by this financial reporting or the traditional financial reporting, right? As a result of that, I told you that the different reporting frameworks have been evolved. So one of the very dominant, or I would say one of the disruptive innovations in the field of corporate reporting, which has taken place recently, that is going to be the integrated reporting. So this integrated reporting has realized this limitation, or acknowledged the limitation in this traditional financial reporting. And because of that, they have introduced a new reporting model, which is based on the 6 capitals. So traditionally, we talk about the financial capital and manufactured capital. The financial capital is simply the equity and debt capital. So for that, we call it financial capital. Manufactured capital, in the sense, it's about the PPE, inventory of an organization. Manufactured physical objects that are available to an organization for the use in the production of goods or the provision of services. This is basically the PPE. PPE, even you can say inventory, right? So this is the traditional capitals. So this is available for any business organization, and it is heavily being disclosed under the traditional financial reporting. But when it comes to the rest of the things, rest of the capital, this is new. Especially the intellectual, that is what we have discussed. Larger part of this intellectual is ignored in the traditional financial reporting. So because of that, under the integrated reporting, we are reporting about this intellectual capital. So we can measure our brand name. So we can talk about the customer satisfaction. We can talk about our relationships likewise. So we can sometimes not in a quantifiable basis, but in a narrative form, we can talk about the intellectual capital of an organization. Our knowledge-based intangibles, the organizational intangibles we can talk about. So that is our intellectual capital, right? We can talk about the knowledge of our employees, so the different systems, the processes, what we have created, the copyrights, the softwares, whatever the patents, what we have, all these things comes under the intellectual. And human capital, it is about the competencies of the people, the capabilities, the experience, their skills, and whatever the expenditure that we incur for them to develop their skills, and also the employee engagement, employee satisfaction. Likewise, we can talk about the human capital. And similarly, you can talk about your relationship, the social and relationship. That is the relationship that you maintain with the customers. So the customer satisfaction, the customer relationships that you would maintain, and also the supplier relationships, and the relationship with the government. So likewise, whatever the relationship that you would maintain, so you can discuss about that. So it may not be quantifiable, but it is okay, but still you can narratively talk about that, narratively present that. It's about the social and relationship capital. And similarly, the natural capital. So you can talk about the natural capital, the water resources, the air, whatever the natural resources that is available to an organization, the land, minerals, and the forest. And whatever the initiatives that you've been taken to improve that, to conserve that, and also whatever the performance measures that you have used there, maybe the carbon footprint, maybe the energy consumption. So likewise, whatever the measures that you have taken, whatever the performance indicators that you are using to quantify that, those aspects can be discussed. So this is the newest revolution in the corporate reporting, and we have a dedicated session on integrated reporting. So there you would be able to discuss the integrated reporting, but basically it is about the talking about the 6 capital. So creation of a value creation of an organization by using the 6 capital. How an organization create value using 6 capital. The capitals in the sense resources. ආයතනයක් කොහොමද මේ කියන ආකාරයේ capitals වර්ග 6ක් භාවිතා කරලා value එකක් create කරන්නේ, profit එකක් create කරන්න කියන broad story එක තමයි narrate කරන්නේ integrated reporting tool. So these are the developments for the criticisms of the traditional financial report. So therefore, to a large extent, almost all the capitals being discussed. Right. That is major part of that. I'm taking, I have already exceeded some time. But would you allow me another 20 minutes time, I would say, so to take you through the rest of the content? Would that be fine by you? Another 20 minutes time? Yeah, I might be able to go through. So only few slides are left. So would like to take you through. Will you be fine with that? Okay, right. Thanks. Right. So let's, so it is about, now we have finished discussing. It's about the things that is largely being ignored under the traditional exclusion of activities from the financial reporting process. So the one thing is about the intellectual and intangibles and intellectual capital. So we have discussed about that. Now we are moving on to the reporting social and environmental impacts of organizational activities. So it's about the voluntary disclosures. Right. So when it comes to these disclosures from the very beginning, the product of financial reporting, we discussed that we have these mandatory disclosures and voluntary disclosures. So the mandatory disclosures, it is basically the general purpose financial statements and its focus on economic performance. So it talks about the economic performance. But when it comes to the voluntary disclosures, basically they are considering about the social performance of an organization as well as the environmental performance of an organization. So hence their focus is beyond the economic performance. And also you can argue that you're broadening your scope for the accountability. So here you're assuming your accountability in a very narrow sense. So when it comes to the conceptual framework, there we basically discussed when it comes to the financial statement, our accountability is mainly towards the capital providers. So we were pretty much concerned about the capital providers, in the sense the investors, the lenders, and other creditors. So therefore, we are on a narrow focus. Our accountability was narrowly defined. But when it comes to these voluntary disclosures, together with the voluntary disclosures, what we are trying to achieve is that we are trying to broaden our accountability. It is not just to shareholders, but even to stakeholders, the broad stakeholders. We are considering about the customers, the suppliers, and the government, the general public, the society at large. Likewise, we are broadening our accountability. We are not just assuming an obligation for economic performance, but for the social dimension as well as the environmental dimension. So it is about the voluntary disclosures. The annual reports contain both mandated financial statement and the voluntary disclosure. The information outside the financial statement is not audited. You know, when it comes to this voluntary disclosures, largely it is not audited, but still at the same time, I would like to emphasize that in the present environment, there's a tendency that we are even going for the non-financial information audits. That is the newest trend, I would say. So far, we used to have that financial statement audits, but nowadays in the environment, you might find that even we are going for that non-financial information audits. That is even there. So therefore, in this voluntary disclosures, even the auditing is there to some extent. It's a very innovative or very new area. So especially when it comes to the integrated reporting, those aspects, the non-financial information, sustainability reporting, we consider that. The annual reports can be used as a marketing tool as well as a convey of a particular organizational image to its readers. So if you are to see why these organizations are going for voluntary disclosures, so what is the tendency, what is the reason behind these voluntary disclosures? So in fact, there are several reasons. So out of that, we can say that when it comes to these annual reports, we can use it as a kind of a marketing tool. So we can convey a particular picture of an organization to its audience, to its stakeholders. So we can convey. So by taking a position that we are considering about the environment, we are considering about the society, so we can convey that as we are kind of a very ethical player. So that is the image what we can create. So we can convey a particular image about an organization. That is through the voluntary disclosures. We cannot do that using the mandatory disclosures. Using the financial information, we may not be in a position to do that. But through the narrative disclosures, so we can convey whatever the sustainability activities, whatever the environmental conservative activities, whatever the societal initiatives, whatever the CSR activities that we have undertook. So in a way to communicate a good picture of an entity. So that is also possible. So that is one of the motives for these voluntary disclosures. The narrative disclosure, voluntary disclosures in annual reports used to report activities excluded by accounting standards from the financial statement. Yes, as we discussed. So whatever that is being ignored largely by the financial accounting standards can be communicated through the voluntary disclosures. The accounting standards never worry about the economic performance, the social performance. They never worry about the capitals other than the financial and the manufactured capital and some of the intellectual capital. So they don't worry about the social and relationship capital, the human capital. So nothing is being addressed. But through the voluntary disclosures, yes, we have the room for those information to be communicated. The impression management used to improve the corporate image and can be biased, even misleading. Yes, there's a risk that, when come to the voluntary disclosures, it is largely non-audited. It is largely non-audited. So therefore, there's no guarantee. Whatever the picture that may communicate can be different from the actual practices. So we call it decoupling. Decoupling is possible. So they may report something, but that may not what they may practice. They may try to show that they are a good player, they are ethical player, but truly they may not. So therefore, this is a kind of a voluntary disclosure. We cannot guarantee that it would communicate the true picture, but there's a risk, and sometimes it may be a very biased, misleading picture can be conveyed. So you need to be attentive of that as well. Right. What are the main types of voluntary disclosure provided in the annual reports of Sri Lankan companies? In fact, we have discussed that. So in the very beginning, so we have discussed. So therefore, let me skip that. Right. Then I come to an important thing. It is about the motivation for disclosure. So as we discussed, when it comes to these voluntary disclosures, there can be several reasons for that. Then why the management is worrying about these voluntary disclosures? So why they are going for these voluntary disclosures? So by now we have discussed some of them, but just to take you through, one of the main reasons is that it is about you want to show that whatever the values of the business or the management values is in line with the social values. So you are in accord to the societal values. You want to show that you are seeking the legitimacy, right? You want to see that. You want to see the society to perceive you that your values are in line with the values of the society. So in a sense, you are a very ethical player. So that is one reason. So through the voluntary disclosures, you have the capacity to do so. So if you can show that some of the social initiatives, the environmental initiatives, so that itself communicate that your values are in line with the societal values. So that is one. Then at the same time, so this will help you to protect from the attacks from the pressure groups. So when you place in society as a very ethical player, that itself provide a shield. It itself provide a shield that you cannot be attacked by the pressure groups, even though the different parties are trying to attack you. But because of the image that you have created in the society, that itself provide a kind of a shield. So no one can attack you very easily, right? So therefore, that is also another motivation, right? It provides a kind of a shield from the potential attacks. And also improve the corporate reputation. So you can improve your reputation by way of the communication that you would maintain, by way of the communication your initiatives, the social and environmentally helpful. You can improve your reputation. They provide opportunities to lead the debate, in the sense that, in accounting or in the accounting literature, so the different reporting are being discussed, like the social reporting, that is in sustainability reporting, and the integrated reporting. Likewise, different reporting are being discussed. So therefore, this organization, if they really practice that, so then that will help to lead the debate, right? So they provide the classic examples. Of this, what do you call that? The whatever the uh, reporting are on debate. And the secure endorsement, they demonstrate strong management principles, the same aspects, and demonstrate social responsibilities, more or less the same. So likewise, these are some of the motivation that the management would have to go for the disclosure, right? Then even the certain theories is even developed to explain why an organization is worried about these voluntary disclosures. So in that, the several theories, in fact, the accountability theory, the legitimacy theory, stakeholder theory, institutional theory, the positive accounting theory, all these theories are trying to explain why an organization would go for these voluntary disclosures. Why organization would go for the voluntary disclosures. So we will see what is the main thing that each of these theories would identify, which of these theories would put forward as the main argument for these voluntary disclosures. So it is simply out of the reasons what we have highlighted earlier, probably. So you might see that uh, more or less these reasons is what it is highlighted even in the theory. But ලෝකයේ එක එක theories බිහි වෙලා තියෙනවා මේ voluntary disclosures ඇයි ආයතන voluntary disclosures කරන්න කියන එක. ඒතර අපි බලමු එක එක theory එකේ මොකක්ද argument එක ඇයි voluntary disclosures මේ entities කරනවා ඇත්ත කියන එකට. So let's start from the accountability theory. It says that it gives the corporation through their management as reacting to the concerns of external parties. So when it comes to this external theory, accountability theory, the main argument is that they see that the organization through its management are responding to the concerns of the external parties. The expectations of the external parties, they are being addressed. The accountability involves monitoring, evaluation, and control of organizational agents. So when it comes to these agents, so the owners, they have entrusted the resources. So the management are the ones who manage that. So therefore these owners, in the sense the investors and the other stakeholders, they might require the information to monitor, evaluate, and control the organizational agents, the managers. Accountability focus upon the relationship between the corporation and the users of its annual reports. When it comes to this accountability, the different definition is also being provided. It says that the Gray et al. 1996, they says that the accountability would involve the duty to provide an account or reckoning of those actions for which one is held responsible. In simple words, this accountability has two aspects. What I have even highlighted the other day, one is about undertaking certain activities and also providing an account of those activities. So once the managers are entrusted with the resources, so they need to put these resources to the best use. That is about responsibility to undertake certain actions. The other one is that they need to communicate this to the stakeholders. And again, when it comes to this accountability, basically we can take different views of the accountability. So you can either take a narrow view of the accountability, in that you can view this accountability towards the capital providers. In that sense, you are thinking about, as it was discussed under the conceptual framework, the financial resources being entrusted to the management, they need to put that to the best use and they need to generate results, and that must be communicated. So that is the narrow sense of accountability. But at the same time, you can assume a kind of a broader sense of accountability. In that sense, it is not just the shareholders, but even the other stakeholders. When the other parties in the society would provide the resources to an entity. So if you take employees, they would provide the labor. So if you take the government, they would provide the infrastructure. So if you take the society, so they would provide them with the opportunities, or they would serve as the customers, right? So there would be suppliers. Likewise, when it comes to an organization, it's a nexus of contract. So there are different parties would involve. The different stakeholders are providing different kinds of resources. So hence, then organization can assume a broad accountability towards them. So in that, their accountability may go beyond this economic dimension. So they might have to assume accountability that goes beyond the economic dimension, that is to the social dimension, even to the environmental dimension. So therefore, it is broad. So you might have to do certain activities to preserve the environment. You might have to do certain activities to do good to the society. So that is part of accountability. So therefore, if you talk the accountability in a broader sense, the accountability would basically in a broader level. So you might have to attend to the expectations of the different parties in the society. So therefore, it is at the level at which you would explain. So hence, this is what I was explaining. When it comes to this accountability, so we are looking at what is the motive. So therefore, here, what we can, in a summary, say that the accountability is about the motivation is that meeting the expectations of the stakeholders of the society. So here, in this particular theory, they assume that organization would engage in voluntary disclosures to meet or to satisfy the expectation of the society, or to discharge the accountability towards these stakeholders, to discharge the accountability towards these stakeholders. So අපිට මේ accountability theory එකේ basically තියෙන argument එක මොකක්ද කියලා බැලුවොත්, ඇයි ආයතනයක් voluntary disclosures සිද්ධ කරන්නේ? ඒකට හේතුව තමයි ආයතනයට තියෙනවා යම්කිසි accountability එකක් society එක සම්බන්ධයෙන්, stakeholders සම්බන්ධයෙන්. So the stakeholders ලාට තියෙන accountability එක discharge කිරීමක් විදිහට තමයි මෙයාලා මේ දේ සිද්ධ කරන්නේ. අපි environment එක preserve කරන activities වල engage වෙන්නේ, society එකට වඩා හොඳ දේවල් අපි කරන්නේ. ඒ දේවල් කරන්නේ අපි assume කරනවා accountability එකක් broader society එකට. එතකොට ඒක financial performance වලට එහා ගියපු දෙයක්, ඒක societal performance එකක්, ඒක environmental performance එකක්. ඒ නිසා අපි ඒ accountability එක discharge කිරීමක් විදිහට voluntary disclosures adapt කරනවා වෙන්න පුළුවන්. So it is about to communicate the whatever the measures that we have taken to discharge our accountability, right? So here, as I said, that you can take a very narrow view of the accountability, that is the reject view that the corporation managers have any moral obligation, but from a broader sense, organization earn their right to operate in the community, accountable to the society for how it operates. Societal expectation exceed the profitability. So you need to meet the societal expectation. So you need to discharge your accountability towards the society. So that is the prime premises of the accountability theory. Similarly, if you look at the legitimacy theory, in this legitimacy theory, basically what happens is that, again, the primary premises is that here it always assumes that there's a contract between the society and the organization. There's a contract between the society and the organization. So therefore, organization, what they need to do is that in order to maintain this legitimacy, so they need to ensure that the expectation of the society is met. So for the organization to be appear legitimate, they need to ensure that the expectation of the society being met, right? So that is what the legitimacy theory says. So therefore, the legitimacy theory, what they are basically trying to do, they try to show that the management values are in line with the societal values. So that is the main motive behind the legitimacy theory. So the legitimacy theory basically there is a social contract. There is a contract with the society and the entity. Entity එක සහ society එක අතර contract එකක් තියෙනවා. ඒතකොට ඒක තුල අපි legitimate වෙන්න නම් අපි expectations වලට societal expectations වලට adhere වෙන්න ඕන. So in other words, you can say we want to adhere to the societal values. So the management values or the organization values has to be incongruent with that of the societal value, right? So the societal values, so the time to time it evolves, it changes. With that, the organization should need to respond. So you need to appear legitimate. Similarly, when it comes to stakeholder theory, they are taking the same position. It is about the expectation of the stakeholders. So earlier we take the society as a whole, the expectation of the society as a whole, but here we are taking the expectation of the different stakeholders. So in fact, there are two branches, the ethical branch and the managerial branch. So when it comes to this managerial branch, what we basically say is that there we consider about the powerful stakeholders. The stakeholders, those who control the resources of an organization, or is what we call the powerful stakeholders. So we need to attend to the expectation of the powerful stakeholders. So through the voluntary disclosures, what we are trying to do, we are going to show that we are working in line with the expectation of yours to satisfy the expectation of the powerful stakeholders. So the stakeholders like suppliers, the customers, the capital providers, even the government, we need to show that our business operations are in line with the expectations of yours. So how we can do that? We can do that by the voluntary disclosures. So whatever the societal initiatives, whatever the environmental initiatives we take. And the ethical branch of the stakeholder theory assumes that is about the responsibility for all the stakeholders. They are not going to make any distinction, the powerful stakeholders and the others. Instead, they are taking the viewpoint that all the stakeholders. So we must attend to the expectation of all the stakeholders. So that is the viewpoint that the stakeholder theory is taking. So it is about the expectation of the stakeholders. So when it comes to this legitimacy and the stakeholder theory, you would find that it is more or less similar. It is about the expectation of the society and the expectation of the stakeholders. But it is slightly different. It is said that, so the earlier one, the legitimacy theory considers the expectation of the society as a whole, while the stakeholder theory would consider the expectation of the each of the powerful stakeholders when it comes to managerial, the ethical, each of the stakeholders when it comes to the ethical, each and every stakeholder when it comes to the ethical. So that is a kind of a slight difference, but more or less the story is same. It's about the expectation. So similarly, you would find that the institutional theory, even you'll be discussing these theories in detail, but here just to show that when it comes to the institutional theory, we basically talk about the three isomorphic pressures. So like the coercive pressure, the mimetic, and the normative pressure. So then the organization would adopt the certain environmental and societal practice as a matter of these different pressures, the isomorphic pressures. So because of the coercive pressures, the pressure of the parties that you would depend on, so you may adopt certain practices, especially if the government would require you to adopt certain environmental practices, you would have to adapt, right? If some of your powerful buyers need to adopt certain practices, you would have to adapt. So it is the coercive power. Or in sometimes it can be a mimetic pressure. So in the sense, the other players in the industry are adapting certain environmental and societal practices. So as a matter of this mimetic pressure, you might have to adapt certain practices. And at the same time, there can be normative pressure as well. So there is a pressure comes from the profession. So as a matter of that, certain practices has to be adapted. So likewise, so because of these pressures, you might have to adapt certain practices and you might have to voluntarily disclose that. And looking at from a positive accounting theory, you would find that the disclosures is having some value relevance. So whatever the environmental disclosures, whatever the societal disclosures that you would make, the voluntary disclosures, it is having a value relevance. So it is having some implication to the share price. So because of that, you would disclose that. So that is another motive for this disclosure, voluntary disclosures. So likewise, you can read further on that. The materials is available. And then finally, you can see that the boundaries of this financial reporting that is evolving. So we, in 1970s or 1960s, we started with the traditional financial reporting. Then after some time, so having seen the disruptions in the environment, the business world has to accommodate the reporting considering the environmental consequences. So it was called the environmental reporting. So the financial reporting was broadened to incorporate this environmental reporting. Then thereafter, sometime somewhere in 1980s, so the societal, the social reporting in the sense the CSR. So as we discussed, the CSR reporting had become prominent. So with the identification that the business organizations have some moral obligations other than making profits, so they have moved on to this social reporting. Then thereafter, the discussion has came into that the profit, planet, people, the triple bottom line. You cannot just make profit. You need to consider about the environment, the people. So the triple bottom line reporting has evolved, and after some time, refining that, the sustainability reporting has come. Again, the triple bottom line concern is there, the profit, people, planet, but considering about the sustainable consumption. So it is about the sustainable reporting. Then in 2020, we have the latest reporting or the most disruptive innovation in the corporate reporting, and we call it the integrated reporting. So it is about the integration of the material information that is reported under the different reporting to a one reporting uh, framework. That is called the integrated reporting. So it is not a kind of, I would say that new, but it's a kind of a very innovative thinking. It's about identifying that the material information that is communicated under the different reporting to tell the value creation story of an organization. So this is extensively, this will be extensively discussed. We have dedicated session on this sustainability reporting and integrated reporting. So in that we can discuss the things in detail. But here just to show that with the criticisms that comes in the business environment for this financial reporting, this reporting gets evolved, right? So this is a evolution of financial reporting, from financial reporting to integrated reporting. Right. Then thank you very much. So I have taken nearly 30 minutes time, and thank you very much for your patience. And yes, so if you have any questions, now it is the time we can discuss. So otherwise, that is all what I wanted to discuss with you the today's discussion. Anything that you would like to add or anything that you would like to get clarified further? Yes. So since we have already gone out of time, that yeah. Right. Okay. Then thank you very much. So then see you in the next class. Good night to everyone.
Thank you, sir. Good night.